doors are muffled. Welcome. I've been given the difficult task of exciting everyone after coming from online calls and Zooms, Microsoft Teams and everything. So welcome to the CFA Institute Research Challenge, the CFA Society East Africa edition, the Kenyan sub-edition, if I can call it that. Unfortunately, we are starting a little bit late, I think 15 minutes late, but I promise we'll be able to catch up. My role today is not to spend so much time to tell you about the challenge, but to pretty much give a bit of a brief of the CFA program and a bit of also the challenge from a global perspective. And then we can jump into it. I know everyone is anxious and you're looking forward to just having the whole process start on. My name is Francis Nasiomba. I'm a CFA charter holder. I am a principal working with Raising Capital and Investments, a boutique corporate finance advisory firm. I've been the president for the CFA Society East Africa for 2 years. I had to be reminded. And I am very happy to have all of you here. First, I'd wish to recognize the cooperative bank team, who are the subject company. So for all those who've been doing research and you've just been looking at numbers and annual reports and the CEO's photos, there's also part of the staff here. So maybe if you can just put up your hand. Thank you so much. And as I start off, I also just want to pretty much acknowledge the charter holders in the room. For most of them who are here, if not all of them, including myself, we are volunteers. And by volunteers is, you know the definition, meaning we offer our time, our resources, our skills to ensuring that we support the society. So I know there are many dotted all over. You will get to interact with most of them. You've interacted with some as industry mentors. You'll also interact with some as the judges. And also you've interacted with some, or you will interact with some as the graders. So my request, just if you can put your hand up, if you're a CFA charter holder, just put your hand up. Yes, thank you so much. I'll not go naming all the names. I just want for the candidates or the students to see that some of the members are actually here. I have a presentation to make. Unfortunately, I have a very short time, so I will move very quickly. For most of you who have not interacted with the CFA Society or have a little to know about the CFA Charter, it is a global designation. It's a graduate level credential, meaning you have to have graduated to actually start on it, or at least you should be in your last year of your undergrad. It has more than 150,000 members across more than 154 countries. And it's recognized by very many regulatory bodies across the globe. We are actually working with one of the regulatory bodies in Kenya to make sure that it is also incorporated. That's an ongoing process. We have currently globally 425 universities who actually incorporate the CFA curriculum into their degrees. So there are some universities that for you to do your master's, if you have your charter, you can actually be able to be or get exempted in some of the courses. People do it for different things. Nina here from Paris said she wanted a globally recognized qualification that will prove her competence. And we actually pretty much engage it for different purposes. Currently, the program has 354 or more thousand candidates. That is level 1, level 2, all the way to level 3, spread across the whole world, the Americas, the EMEA, and Asia Pacific. On the EMEA side, we have more than 35,000 CFA charter holders. Joyce, I don't know how many charter holders we have in Kenya so far. We have roughly 160 charter holders, which is such a small number for a population of slightly over 50 million people. But again, it just shows you that it is not a credential that comes easy. You have to really put in a whole lot. Most of you here are doing it mainly because of what Dr. Bruce is saying. For him, early in his career, the boss told him that if he was to be successful, he'd better think about earning the CFA charter. Most of us actually did that mainly because of our careers. Busting your bubble, it is not only the charter that will help you. You also need to be human beyond that. The CFA charter has 3 levels, level 1, level 2, and level 3, covering portfolio management and wealth planning, asset classes, equity, fixed income, derivatives, and alternative investments, investments tools, financial reporting and analysis, the famous one, qualitative methods and economics, and my favorite, ethics and professional standards. This one will cover ethical decision-making framework, skills to demonstrate commitment to high standards, and accountability. I love this slide, and for me, it's a very important one. It is very easy to be clever. It's very easy to be bright. It is very easy to be very good analytically, and actually to be a quant even in your mind without needing computers. But it requires a higher level of commitment for you to be ethical. And I'm sure you've read a whole lot of newspaper articles. You've read a whole lot of stories, including books written. How many of you have ever read a book called Bad Blood? Or heard of it? Thank you, Kevin. Read books. Beyond 140 characters on Twitter. Anyway, I'm kidding. But my point is, it is very easy to misuse other people's money. Our industry, our profession is built on earning our income based on other people's money. It means at any one time you are responsible for other people's wealth and their livelihood. So if you end up running a Ponzi scheme, you're not only affecting one person, you're affecting generations, families, and people beyond the person that you're actually trying to scheme from. So for me, the biggest takeaway for the CFA charter is actually ethics, more than anything. It is literally that we need to be ethical in our day-to-day practices. And you've seen it, not just globally, we've also seen it locally. And unfortunately, in some cases, the CFA members, CFA charters have been implicated, if I can say that. And it is our responsibility to ensure that we are ethical. If we are not, then down the line, we're not going to be able to have this profession in place. The charter holder employment by title ranges across. I think the most famous is portfolio management, all the way to accountants and auditors. We also have chief level executives. And most of them are seated under equities. I guess that will explain to you why you're doing an equity analysis for this research challenge. And it goes all the way down to commodities, foreign currencies, indexes, VCs, and all that. What I always find interesting is we have charter holders who are medical doctors. And for me, that's always find it very impressive that someone chose to go through these and they are medical doctors. Top global employers, I want to throw a challenge to our secretariat led by Joyce that I'd wish to see this for Kenya. I suspect one of the major employers should be Lizzie's employer here. Must have a whole lot of charter holders. So Joyce, my challenge is I'd wish to see this. Can I see the top 20 employers of charter holders and candidates in Kenya? But for those who like big global names, you can see them there: Citigroup, TDB, Ernst & Young, Goldman Sachs, and all that. Yeah. So enrollment, the requirement, an undergraduate degree, a bachelor's equivalent, or at least being the final year of your bachelor's degree program. Work experience, 4 years. The beauty is this can run concurrently with you doing your studies, so you don't need to finish your studies to start earning your experience. And combination of the two can also qualify you to start out. For you to get the charter, you need to pass all the 3 levels. The levels are sequential. So you have to pass level 1, then level 2, then level 3. There is no doing them concurrently. You have to have earned your 4 years qualified work experience. You have to get at least 2 to 3 letters of reference. I think 2 or at least 1 of them must be a charter holder. So talk nicely to the charter holders in the room. And finally, you get your charter. The fees, for those who participated in the scholarship, you understand why this slide is important and why the scholarship conversation was important, because it is not a cheap cost. You have to pay a one-time program enrollment of $450,000. Depending on when you register, there are early exam fees, standard exam fees, and late exam registration fees. And that's from $650 to $950 and $1,380 respectively. So, this is Rana saying that the CFA program taught her a valuable skill, and that's how to analyze. And the part I like is her saying how to study. The one thing you learn from the CFA program and studying for it is you have to really balance between your personal life, your studies, your career, your education. So it's a very challenging, for me personally, it is the most involving exam I ever did. And I thought doing electrical engineering in university would have been the most involving. Yet this was the most challenging that I ever did. So with the charter with you, you develop a comprehensive investment perspective, gain fluency in practical investments, you become sought after by employers, and you gain flexibility in the work and marketplace. But for me, the most important thing is the community that it introduces you to, the fact that you can actually be able to talk to any charter holder anywhere in the world, and because they know you're a charter holder, there is a level of respect that they give you. Once you introduce yourself as a charter holder to any other charter holder anywhere in the world, they understand what you've gone through, they understand what skill set you have, the competencies you have, and all that. So, what am I trying to say? My long conversation is I am encouraging you to be a CFA charter holder. It is a rigorous journey, yet fulfilling. It is rewarding both in terms of employment, but also at the same time in terms of the lessons that you learn. It does not teach you to become an in-depth expert in any of the items that you are taught, but it gives you a background and a basis for you to choose on where to start. But today, I'm not here to sign you up. I'm actually here to get you into understanding what the research challenge is. So just a quick background. The CFA Society East Africa is a society under the CFA Institute. It's an East African society. It covers the East African countries: Kenya, Uganda, Tanzania, Rwanda, Burundi, and now we're looking at South Sudan. The research challenge is currently running in 3 countries: Kenya, Uganda, and Rwanda. The research challenge is actually a global challenge, and it's run across the different societies and pretty much for all those who like sports and leagues. It starts from the low leagues and grows all the way up to the Champions League, if I can call it that. And it's organized by the local societies, and the winning teams are promoted to the next stage, the regional stage, all the way to the global stage. I don't know if we've ever gotten a team to the finals. 3 years ago, we got a team to the finals. So I hope among some of you here, we are going to get a team to the finals. I can see everyone shaking their head. I'm happy with that. So all I need you to have is confidence. So how does it work? The CFA, the local society volunteers work in conjunction with local universities to assemble a team of 3 to 5 business and finance students. I reiterate, all the charter holders here are volunteers, volunteering their time and effort. Each team works directly with a mentor. I'm sure you've all been working with a mentor. If not, then we need to have a discussion. And then the findings are evaluated by high-profile panels. So here you have heads of finance at leading institutions. You have head of investments at this panel. So they have done these analyses for a number of years. They can see what you're saying, what you're not saying, and that's how they evaluate. Then the local champions advance to the sub-regional competitions, then to the regional competitions in the Americas, Asia Pacific, EMEA, and then you go to the global final. I genuinely pray and hope that some of the teams here can be able to proceed all the way to the global level. Benefits, real-life learning experience. As an equity analyst, you get in-depth training into the company. Develop your CV resumes, get hands-on mentoring, especially from the industry mentors. I'm sure you've already worked with them. Even if you don't win, there's some things they've taught you and you start appreciating. Networking with professionals. All these are professionals. All these are people you can only get on LinkedIn and they won't reply your messages. So please make sure you have a conversation with them before you leave here. If there's one thing you should live with, it's at least one relationship. And if I digress, networking is not about getting 100 cards. It's about creating that one relationship that person will remember you. So identify one person and figure out, I want to create this relationship with that person in here. He's lost his voice, so I don't know how he'll help you. Yeah. But most importantly, for those who are capitalistic and don't pretend about it, there is a $500 check, yeah, for the winner. So I guess this was way before COVID, when we were, how can I say, we were free and adventurous, all these people in one room. I guess these things are going to change in a short while. So the 2021 Research Challenge, there were 5,000 students in that challenge, 3,000 volunteers, more than 150 societies participated, more than 900 universities, and there were 113 local challenges in 91 countries. So when you achieve this, like we say on the CV, it's a very important thing. These are some of the regional champions, and the global champions were the Norwegian Business School, representing the CFA Society Denmark and the CFA Society of Norway. So I'd really wish for next year to be saying one of you is the global champion representing the CFA Society East Africa. Those are the sub-regional competitions and areas. These are the timelines. So the regional semifinals will be in the week of 7th to 8th of April, 2022. And then the regional finals will be on the 28th of April, with the global finals on the 17th of May. We have a number of participating teams. The Cooperative University, we have one team. Are you here? Just put your hand up. Thank you. We have the Strathmore University with 3 teams. Strathmore. Thank you. I'm glad you're not seated together. Cabrak University, 2 teams. Thank you. Pioneer International University, 1 team. Thank you so much. The rest are in Uganda, Makerere University. This same event is happening concurrently in Uganda. They have 2 teams. We have Makerere University Business School, which has 1 team. You have Uganda Christian University with 1 team. And then Kyambogo University also with 1 team. On the Rwandan side, we have 4 teams, 3 representing the University of Rwanda, and 1 for the African Leadership University. So, an important slide for you. As I was walking around in the morning, as I spoke to a few of you, at least the ones who I met, the scoring, the presentation scoring, one will be based on financial analysis, basically how thorough was your analysis on the industry, the company, and the competitors. And that will earn you 20 points of the maximum 100. Valuation, where the valuation methodology is appropriate and detailed. You notice that we are not saying if the valuation was correct, saying if it was appropriate and detailed. So don't focus on the number, focus on the process. That will earn you around another 20 marks. ESG, environmental, social, and governance. Did the analysis thoroughly incorporate conservation of the natural world, consideration of people and relationships, and standards for running a company? That will earn you another 10 points. Presentation, how effective, convincing was their presentation? Was it logical, and did the facts support the recommendation? That will earn you another 20 marks. And then the Q&A, were you able to answer the questions effectively and with confidence? Confidence will take you far. I think between Q&A, presentation, and valuation, yeah, no, just Q&A and presentation, you already have 40 marks. That's literally telling you have 40 marks on confidence. Team involvement, were all the team members involved? Were they not falling over each other, or was there only one guy leading and the rest cheering on? That will earn you 5 marks. And then materials, your quality of your slides. That will earn you another 5 marks. So I hope you didn't spend the whole night preparing slides only to earn a maximum of 5 marks on them. Consider where the other issues are coming from. So the subject company is the Cooperative Bank of Kenya. I'm sure you've done a whole lot of research on it, but so you know far much more on it than I do at this moment in time. And in Uganda, we are looking at Stanbic Bank Uganda Holdings Limited, and in Rwanda, we are looking at the Bank of Kigali. So all the subject companies were banks across East Africa. Some recognitions. Industry mentors, we have, if you're here, you just put up your hand. We have Sajan Shah, CFA charter holder. Maybe just a clap for him for the industry mentorship. Nixon Omondi, I've not seen him. Yeah. Joseph Indagasi, I think I've seen him. Clap for him. Gabriel Mwendwa. Okay. You can still clap for them even if they're not here. And Elizabeth Njega, CFA. Patricia Koki, CFA. Edwin Munene. Kevin Kiprono, Mutuma Laiboni, and Jared Ochieng Opondo. Thank you so much. Those was on the industry mentor side. On the grader side, we have Kevin Kaloki, Eric Maina, Mwambu Malamba, Antonina Oyenga, I don't think she's here, and Vishal Shah. On the judges, we have Elizabeth Irungu. You can just put up your hand and clap for her. If I were you, I'd clap more because she's judging. Yeah, yeah, Richard Murithi, I don't think he's here yet, but just clap for him. Joyce Ndenda, I don't think she's here yet. Kevin Kamemba is here. Yeah, he has no voice, so just write a note for him if you want to talk to him. Maina Washieni, it's a clap for him. And Annette Mulira, a clap for her. So that's on the Kenya side. I'll save you the time not to go to the volunteers on the Uganda and Rwanda side. But all, as you can see, we have a whole lot of volunteers to make sure that we succeed on these. Most importantly, I'd also wish to thank our sponsors, UAP, All Mutual. Clap. So yeah, I hope I've not killed much of the time. So thank you, welcome. I wish you all the best. This will sound cliche, but it's not. The whole idea of you being here is not necessarily to win. The whole idea of you being here is for you to get the experience, for you to interact with industry mentors, for you to get an opportunity to network, and for you to gain confidence as you prepare yourself to get into the industry. Any conversations you have here, any learnings you have here, you'll be able to apply them significantly. And trust me, when you go out there, you will understand that what you are doing is exactly what your boss or your employer would require you to do on your first day at work. So it is an experience and a lesson. So focus on those learnings more than the winning. And on the winning teams, the pressure is on you. We want to see you at the global level. Thank you so much. Joyce. Asante.
Thank you, Francis. Just a few housekeeping rules. You might be aware the washrooms are somewhere directly opposite this door. So if you need to use the washroom, they're just right outside the door. To the teams, you will not be able to see any other team presenting until you have presented. So we have assigned you team numbers. So from team 1 to team 7, you're not allowed to mention which university you come from. So when you walk up the podium, you may introduce your team members by name, but you'll introduce your team as, say, team 1, team 2, team 3, and so forth. So you will present in that order. We have 7 teams. So team 1 up to team 7. We have 2 rounds. Given the number of universities this time round, we'll only have 2 rounds. So this first round, we'll have all 7 teams presenting in that order, team 1 up to team 7. And then the top 2 teams will now proceed into the final round, okay? You will have 10 minutes of presentation. So there'll be a timekeeper somewhere at the side telling you you can start now, and the clock will run for 10 minutes. He or she will give you a 1 minute, what do I say? 1 minute just before the 10 minutes is up. 1 minute mark, you'll be told 1 minute left. And then eventually you need to stop, a hard stop. So there's no continuing to talk, there's no continuing to write on your paper, so to speak. So it'll be a hard stop after 10 minutes. And then now we'll proceed to the Q&A. The Q&A is not limited by time because the judges may need more information from you, so it's not limited by time, but your time is limited to 10 minutes strictly. So we will start with team 1. You'll be walking through this podium, through these stairs because we have the camera on this side. So you will join the podium from this end. And then every other team will be escorted upstairs to 3rd floor. You have 2 breakout rooms where you'll be able to sit and, touch base with your team members just before you present. But we'll be left with team 1 for now, and all the other teams will be escorted to the 3rd floor. And then you'll be called down one by one. I hope that is clear. I think I have exhausted all the rules. One more person I'd like to recognize in the audience is Mr. Richard Macharia. He's joined us from Sanlam Investment. Thank you, Richard. Just raise your hand. We anticipate Old Mutual Investment Group to send a team as well. So just be cognizant, there's some fund managers in the room with you. All the best to all the teams. Thank you. So Priscilla will be able to show you the rooms on 3rd floor. We can have everyone else exit the room except for team 1.
the Lions.
You've never met?
We've never met. We've not met Priscilla. Thank you. You're good?
Good.
Good to see you. Naona amtaki mchezo na shule.
Hivyo ndo tunaendanga.
Sawa.
Haya. Sidani ziko na video, but unataka kuweka just in case. Okay. Ita-interfere na anything? Okay. Great. Bado anachukua chai pale. Team 1, you can take the stage. If the judges are ready, team ready, we can start. Your time starts now.
Good morning, ladies and gentlemen. This is Team 1. My name is Chemtrey Karen. On my left, we have Linda Muridhi, Nyaga Eric, Justus Moy, and Bran Mukiri. We issue a whole recommendation with a target price of 13.11, representing a 1.6 upside on the last close of 12.90 on 27 January 2022. This has been attributed by expected rebound of the economy, expansion into the digital space to improve the overall performance, acquisition of the Kingdom Bank to improve access to a wider market. We can also check on the share performance history. This is how the Cooperative Bank of Kenya has been trading on the last 3 months. We can now go to business description. The Cooperative Bank of Kenya is the largest cooperative bank in Africa and third largest bank in Kenya in terms of asset base, with an asset base of 593 billion. It has 9 million direct account holders. Let's go to regional presence. The Cooperative Bank of Kenya is the largest bank. It's located in Kenya and South Sudan, with each major footprint in Kenya. Let's move to the key milestones. In 2008, the bank was listed in the NSE, having been rated the best. This has been seen by the having the shareholding being the COP Holdings Cooperative with a percentage of 64.56. Let's move to the ESG. The Cooperative Bank of Kenya embraces and acknowledges a well-diversified board of directors. This can be seen with functional committees including finance, audit, loan, nominees, etc. Let's also check on the environmental and social. The Cooperative Bank of Kenya has an impact in the society. It has an impact in social, economic, and environmental. In environmental, it partnered with IFC to offer $75 to partner with the MSMEs. In economic, it has a strong balance sheet. And in social, it offers scholarship to students and also the Samaria Mwema. I now welcome Linda Muridhi to take us through industry overview.
Thank you, Karen. The number of banks in Kenya is still relatively high, despite it reducing from 43 in 2015 to 38 currently. The ratio of banks per 10 million population is currently at 7.1 times, which is a reduction from 9.0 times. This is due to the emerging trend in consolidation, which is seen through mergers and acquisition. Cooperative Bank recently finished a 90% acquisition of Kingdom Bank that was formerly known as Jamii Bank. Industry performance. The overall industry performance has been stable due to stable macroeconomic conditions. This is seen through a 5-year historical average of the ROE, ROA, portfolio yield, and NPL that recorded at 22%, 2.6%, 11%, and 12% respectively, with an exemption of financial year 2020 due to effects of COVID-19. The market share structure. Cooperative Bank is currently ranked as number 4 according to its market share of 9.56, and is among the 9 largest banks with a combined market share of 74.55%. Now welcome Eric Nyaga to take us through competitive advantage.
Thank you, Rita Moridi. Deep root within cooperative sector, Coop Bank has boosted 15 million members as a key player in cooperative movement, growing digital channels with 93% of their transactions in alternative channels, diversification of revenue channels, through adoption of universal business model, proactive credit management, up to 50% of their loan book is in consumer banking, which is performing well. Moving on to financial analysis, profitability, net interest margin has been stable at a 5-year historical average of 9%, which is slightly above the peer average of 7%. We expect the net interest margin to be stable, moving on to financial year 26 due to stable growth in loan book, stable growth in deposit, which provides cheap cost of funding. Return on equity and return on assets, they have been stable and in tandem with the industry performance. We expect the return on equity to maintain its range of 20 to 22% moving forward to financial year 26. This is due to optimal financial leverage and stable net income margin. We also expect the return on asset to maintain its range of 3 to 4% moving forward to financial year 26. This is due to stable profitability and stable growth of banks' asset efficiency. Cost to income ratio has been stable at a 5-year historical average of 60%. We expect a slight rise by 2% to 62 moving forward financial 26. This is due to continuous digitalization of portfolio risk. This means out of everyone Kenyan shillings of the operating income, at least 60% goes to the expenses. Operating expense ratio, they have been stable at a 5-year historical average of 10%. We expect a slight rise by 1% to 11% by the end of financial 26. This means out of everyone Kenyan shillings of the loan book, at least 10 to 12% goes to the expenses. I invite Justus to continue financial risk.
Thank you, Eric. Let's look at the cooperative bank asset quality. Cooperative bank asset quality has been in line with that of the industry, with the exemption of the financial year 2020, where we see that the NPL ratio was at 18.1%, compared to that of the industry that was at 15.6%. while the cost of risk was at 2.65% compared to that of the industry, which was at 2.18%. The high ratios can be attributed to the acquisition of Kingdom Bank, which had high NPLs. However, we anticipate the asset quality to improve with time, given the expected rebound of the economy. On capital, Cooperative Bank has a sound capital position. We see that the Tier 1 ratio for Coop Bank is at 15% compared to the 10.5% minimum requirement by the CBK, while the total capital ratio is at 17% compared to the 14.5% requirement by the CBK. The core capital ratio is at 18% compared to the 8% requirement by the CBK. These ratios act as the first lines for defense for the creditors and provide safety for their money. Liquidity. Cooperative Bank is liquid. We see that the loan-to-deposit ratio for Cooperative Bank has been above 80% in the pre-COVID era, and we anticipate it to be above 80% in the post-COVID era. And 80 to 89% loan-to-deposit ratio will be healthy for Cooperative Bank. The liquid asset total asset ratio for Coop Bank is currently at 52.2%, and we anticipate it to remain above 45% in our projected years. These ratios show that the bank can be able to fund its cash outflows from the assets. And now I'll come Brian to take us through valuation.
Thank you, Justice. For the valuation, we used a blend of intrinsic and relative valuation techniques to come up with our target price. This was necessary because of the business model of the bank and the balance sheet structure, in which it is difficult to come up with the working capital and interest expense, which is deducted for other free cash flow methods. Under the intrinsic valuation, we use DDM and residual income. For the DDM, we use the capital asset pricing model to calculate our cost of equity. The CAPM assumptions are a risk-free rate, which is got from a 10-year treasury bond. This is fit for our investment horizon. Beta, it was attained from Bloomberg. Market risk premium of 5% from trading economics. Other key assumptions is a 45% payout ratio. This is based on the historic range of 40 to 50% over the last 5 years. We also did a sensitivity analysis later to see the effect of the changes in the payout ratio on the target price. This will be covered under valuation risk. For the terminal value, which accounts for the going concern, it was accounted using the perpetuity method. This is necessary because it is easy and fair. We can incorporate other data into the key revenue drivers, example loans, which we projected will grow with the GDP. For the DDM, we got a price per share of Kenya shillings 10.57. Moving on to residual income, we calculated and discounted the residual and terminal values to get negative 33 billion. Add the beginning book value of 100, divide by outstanding shares, we get Kenya shillings 11.44. Of note here is that the ROE range is between 20 to 22% for the forecasted period. This is above the cost of equity of 17.60. This shows Coop Bank gives returns in excess of shareholders' expectations for the forecasted period. For the relative valuation, we use the price to earning and price to book value multiples. We picked peers which are publicly traded at the NSE, and they have a similar asset base to that of Coop Bank with a similar ROE and geographical area. For the price to earning multiple valuation, we got a Kenya shillings 14.49. This is forward Coop Bank EPS financial year 2021 multiplied by the industry median of 5.66 times. Now for the price to book value, we got a 15.95. This is forward Coop Bank book value per share financial year 2021 multiplied by the industry median of 1 times. These methods were then weighted 50% for intrinsic, 50% for relative. This was necessary because the intrinsic shows the growth prospects of the bank. The relative shows the bank's competitive nature, because we can also see that its beta is in tandem with the market. So we got a weighted average of target price of 13.11. Now I invite Linda Murithi to take us through the risk.
Thank you, Brian. Sensitivity analysis. We conducted a sensitivity analysis on key assumptions in intrinsic valuation method, that is by flexing the discount rate and payout ratio, the discount rate and terminal growth rate, and the GDP. And all these yielded to target prices within our hold recommendation from the last close of 12.90. Investment risks. For our key risks were market and operational risk. For market, we found that stiff competition and influx of fintechs were very high. And for our operational risk, we found that cyber frauds were very high. Cooperative Bank has tried to mitigate this risk. This is by, for market risk, expansion into digitalization, and for operational risk through data loss management and service quality charter for their clients. Our hold recommendation was on a target price of 13.11.
Thank you, Timur. We'll proceed to the Q&A.
I'll go first. I'll pick one. There are many. Why did you choose to pick a median price to book instead of weighting it, considering the median pretty much shows the median, but does not factor the risk return in determining the price to book?
So one of the key reasons we use the median is because median, it will deal with the extreme variables. If, for example, we were to pick the mean to account also for the risk, it will be difficult because the mean accounts for all the variables, while the median will deal with the extraneous variables.
Thank you.
Yeah, so I just need you to, you are pretty fast, just to talk more about the competition.
Okay. Okay. Deep root within cooperative sector. Coop Bank has boosted 15 million members as a key player in cooperative movement, which has accounted to 45% of the Kenyan GDP, of the Kenyan domestic GDP, and 30% of the national savings and deposits, directly or indirectly. Under the growing digital channels, with 93% of their transactions in alternative channels such as M-Cop Cash, credits, e-credits, and Cop kwa Jirani, which is even more efficient in the rural areas. Then there is diversification of revenue channels through adoption of universal business model, such as insurance and stock brokerage. There is corporate banking, there is retail and business banking, among others. Under profitability, profit credit management, up to 50% of the loan book is in consumer banking, which is performing well currently. Yeah.
Also on that, we can also add for the diversification of the revenue channels. Traditionally, banks have only been focusing on interest income. This was threatened last year and the previous year because of the COVID-19 pandemic. So they have to diversify so for them to cushion themselves against effects like that. So they have gone further to find non-funded interest income, which does not involve necessarily giving out loans for them to get some money in their balance sheet.
To add on that also, based on deep roots within the cooperative sector, we see that cooperative bank has traditionally been known of, it had a lot of customers. The cooperative sector was banking the cooperative bank, and that has acted as an advantage for cooperative bank.
I have a question or two questions for the voiceless. Number one, the net income margin seems to be better than the industry, but the ROE is lower than the industry. I assume this means the operating efficiency is worse than the industry. Was this considered while computing the terminal value? That's number one. Number two, why a 10-year bond for risk-free rate? Why not 5 years? And then number three, can you define the beta? Was it weekly, daily, or annual?
So let's start with that question on the 10-year bond. Our investment horizon is for 5 years, 6 years. So we have to take a bond that is taking for 10 years beyond our investment horizon. Then the beta, we also got it from an external source. This is because it is not very easy to find all that data necessary for us to regress against the market. So we got the data from the beta from Bloomberg, which we also went ahead to compare it with other sources. For example, we used Reuters and my stocks, of which we averaged, and it was also similar to the one that we got from Bloomberg. And also COP is in tandem with the industry in its performance. So those were the principles that we used for us to come up with our beta.
First question was on the net income margin, and the question was, it seems to be better than the industry, but your return on equity is lower than the industry. So Kevin's assumption is this means the operating efficiency is worse than the industry. And the question is, was this considered when you are considering the company terminal value?
For the terminal value, we considered the GDP because Kenya is the cooperative bank is in tandem with the industry. And for this, we can also see it is also attributed by the beta, which is close to 1. So the terminal value was considered using the dividends in the final year, and also the GDP was also weighted. The key revenue drivers, which is loans, was attributed to the GDP.
Good morning. I'd like you to comment about the NPL ratios, which are above industry, and in your presentation you said you're going to normalize. What is normalize and why are they normalizing?
For the NPLs, where we considered for the financial year 2020, for the cooperative bank, for the financial year 2020, the NPL ratios were high compared to that of the industry. And that we attributed it to the acquisition of Kingdom Bank, which had high NPLs. We anticipated to get back to normalize in the projected years, given its increase, it's diversifying its loan portfolio and focusing more on the consumer loans, which are considered less risky compared to manufacturing and construction in other areas.
For the NPL ratio, we can see that there was a spike in financial year 20. This was caused by the COVID-19, in which they had to restructure most of their loans, which they issued a moratorium to their customers because their loan book is majorly on consumer banking. So that is why we are saying it's going to normalize, given that the economy is now opening up to pre-COVID levels.
We can have one more question from the judges.
Hello, thanks for your presentation. Just a quick question. In evaluation, you used a market risk premium of 5%. I'm just curious what informed that choice, given the realities on the ground, right? We've gone through an unprecedented period with COVID-19. Risk premiums in general have generally risen across the board. So to me, 5% seemed fairly conservative. What informed that choice?
The market risk premium, as you can see, one of the regions, we got it from an external source. But we also went forward, because Kenya is a developing country, we went ahead to check the country's default risk. And we saw that it is a B2 rated country, if you check on websites like Moody's. So it aligns to that 5%. And we chose to be conservative with the valuation because we don't know about the situation is uncertain. If there's a certain spike of the COVID-19, then the levels go back to high. We will be forced to go to another lockdown. So we chose to be conservative, other than advising the investors to be more risky in the handling the stock.
Thank you, Team 1. So team 2, whenever you're ready, your clock starts now.
Good morning, ladies and gentlemen. My name is Olivia Perry, and I'm here with my teammates, Mugambi Wahome, Firdousa Omar, and Tracy Mwenda, to present our valuation of the Cooperative Bank of Kenya. We issue a buy recommendation with share price of 15 shillings and 27 cents, based on with an upside potential of 18.37%. This is based on the share price as at yesterday, which stood at 12 shillings and 90 cents. Ladies and gentlemen, we're aware that the economic environment has changed and since our valuation began. However, we base this recommendation on 3 key factors. 1, economic recovery for higher pricing potential. 2, capitalization on sustainability for higher pricing potential. And finally, we believe that the Cooperative Bank of Kenya is uniquely positioned to leverage technology to increase shareholder returns. Ladies and gentlemen, I'd now like to give you a brief description of the Cooperative Bank of Kenya. The backbone of the Cooperative Bank of Kenya is...
Please pause. Pause. Please hold the mic to your... Yes, thank you. You can start. Hold the mic to your...
Should I begin again?
Yes, please.
All right. Thank you. Good morning, ladies and gentlemen. My name is Olivia Carey, and I'm here with Team 2, and I'm here with my group mates, Mugambi Wahome, Firdousa Omar, and Tracy Mwenda, to present our valuation on the Cooperative Bank of Kenya. Based on our analysis, we issue a buy recommendation of 15 shillings and 27 cents with an upside potential of 18.37%. This is based on the share price as at yesterday, which was 12 shillings and 90 cents. And we are aware that the economic environment has changed since we began our analysis, but we base this on 3 key factors. 1, we believe that there is economic recovery for higher pricing potential of the stock. 2, we believe that the Cooperative Bank of Kenya is uniquely positioned to leverage on technology to increase shareholder returns. And finally, we believe that COP Bank has a capitalization on sustainability for higher pricing potential. Now I'd like to give you a brief overview of the bank itself. The bank was started in 1965, and the backbone of this bank is the cooperative societies. The bank is present in 2 countries in East Africa. This is Kenya and South Sudan. The bank is the 3rd largest lender by assets, and these assets are valued at 536.9 billion Kenya shillings as of 2020. Ladies and gentlemen, the next question becomes, what are the bank's main business segments? The first business segment we have is retail banking. These are services offered to individual investors. The second segment that we have is wholesale banking. This is offered to 3 different types of investors. First, we have the corporate investors. Second, we have the institutional investors, and we have government. The final business segment that we have is the other group functions. These are services that neither fall in the wholesale banking segment, neither in the retail banking segment. Typical examples would be your stock brokerage services, your investment services. Ladies and gentlemen, the question now becomes, what are the revenue, how does COP Bank generate its revenue? This is done in 2 ways. 1, non-interest income, and 2, interest income. And I would like to invite my teammate Mugambi to take us through the rest of the presentation. Mugambi.
Thank you very much, Olivia. We will now look at environmental, social, and governance. I would like to state that COP's ESG standing is strong and sound. When we look at the environmental pillar, there was a 31% increase in green lending, showing that COP incorporates environmental issues even in their core business line. That coupled with partnerships from international organizations such as IFC to secure funding to the tune of USD 122 million to fund green ventures shows that COP COP Bank is environmentally conscious. Looking at the social pillar, we see that COP is a social authority. We have Kenyan shillings 46 billion spent in development funding, and we can also couple this with educating 7,713 learners through their COP Bank Foundation, which is second only to Equity Bank's Wings to Fly program. Where we can fault COP on the social pillar is that they lack gender balance. There's about 46% female employees, and that ratio becomes worse as you rise to the top management, with 19% when you look at the management and 15% when you consider the board of directors. So that is an area that I believe that COP can greatly improve on. Looking at governance, we consider 4 key things. We have a well-experienced board of directors and management. We have a share remuneration structure that is pegged on performance, and a favorable shareholding structure that prevents price attacks. This makes us give Cooperative Bank a score of 93 out of 100 on the corporate governance scorecard. Overall, COP's ESG standing is sound. I will now examine the investment summary, with our first pillar being economic recovery for higher pricing potential of the stock. I want 2 words to stick with you: contraction and recovery. In 2020, in the wake of the COVID-19 pandemic, there was a contraction in many economies, including Kenya and South Sudan, which are the 2 economies that COP Bank is in, with 0.32 contraction and 6.59 contraction in GDP as of 2020. However, GDP was projected to improve in 2021 as restrictions began to be eased, and we believe that that will bolster the loan book, as the bank's loan book is really pegged to the economy, while increasing interest revenue and reducing the cost-to-income ratio as individuals are more financially stable. Therefore, we believe the stock price will see an appreciation. Moving on to the second pillar, uniquely positioned to leverage on technology for increased shareholder returns. I would like 3 numbers to stick with you: a 49% transaction growth year on year, a 30% commission from these online transactions, and a healthy 8% yield on their e-credit line. If we look at the 49%, that is an impressive transaction growth for a single year, and the fact that they have 30% commissions on these online transactions shows that that is a alternative income source, non-interest income source. When you look at the healthy yield on e-credit, e-credit became a very important line in 2020 in the wake of COVID-19, and with that healthy yield of 8%, COP will only leverage on this a lot more to give them now interest revenue as the economy recovers. And our third pillar, capitalization on sustainability for higher pricing potential. As we have looked at the ESG standing of COP, we have seen that it is sound. They have a strategy that looks at economic sustainability, social sustainability, and environmental stewardship. We believe that as investors begin to price ESG appropriately in the market, then COP's share price will see an appreciation. And we would say that this is not far off, as the NSE recently released the ESG reporting guidelines, which means that investors are actually beginning to care about ESG when they make investments. I will now hand over to my colleague Firdosa to take you through the financial analysis.
Thank you so much, Mugambi. For our financial analysis, we will focus on 2 key things: the net interest income and then unfunded income. For the net interest income, the key driver is economic growth. As my colleague Mugambi reiterated, there was a contraction during the year of 2020 because of COVID, but there was economic recovery in Kenya and South Sudan of 5.60 and 5.33%, and this increased the net interest margin of Cooperative Bank. For the non-funded income, we will see online transaction was one of the main key things that drove the non-funded income. There was 164.7 million currently, and it is projected to grow to 300 million by 2025. Something else to consider is we have share registration services and fiduciary duties, as well as foreign exchange activities that the bank considers to ensure that the non-interest income increases. For our valuation model, we use 2 key models, the multiples model and the DDM model, with an upside potential of 18.37%, having a target price of 15.27 and 50% on the multiples and 50% on the DDM model. Our multiples, we considered peers such as KCB, Equity, Stanbic, and ABSA due to their similar business segments and also revenue streams. For our DDM model, we considered these key assumptions: beta, the cost of equity, the risk-free rate, and the book value ratio, some of which coming from the model run and Refinitiv. I will now hand over to Tracy to take us through investment risk.
Thank you, Firdosa. Moving on to investment risks. Investment risks are inherent in any banking sector, and Cooperative Bank is no exception. The key investment risks we've looked at here are those of high probability and also high impact. Starting off, we looked at credit risk, and in credit risk, we looked at a key factor, which is the increase in non-performing loans for Cooperative Bank. We feel like this was attributed to the COVID-19 pandemic that ensued the country and the globe at large and brought most economies to a standstill. Additionally, the change in loan and mortgage repayment that was an emergency relief measure for the impact of COVID-19. The central bank issued a statement under the Banking Circular 3 of 2020 that was supposed to grant relief to MSMEs and customers who had up-to-date payments on their loans that were in line with the Banking Act and provisions. And reassurance to investors is the fact that Cooperative Bank has a very solid credit risk framework that's able to do a thorough due diligence on assessing creditworthiness of customers, which reduces the probability of loan default. Moving on to operational risk, we look at the digital system failures. One, Cooperative Bank consumer experience has led to some digital system failures incorporated in this, such as, slowed online transactions and an inability to use debit and credit cards for certain transactions. Additionally, the Data Privacy Act that came into play in 2019 and that was enacted is very key for Cooperative Bank, as the Act comes in to protect consumer data, and additionally, failure of compliance can lead to up to a 5 million shilling fine. This is important for Cooperative Bank to ensure that their operations are in line with this to avoid this kind of fine accruing. Lastly, political risk. Cognizant of the fact that this is an electioneering year, it's very important to understand in a Kenyan setup that elections are marred with heavy political temperatures and intense campaign. However, a sort of comfort to investors.
Thank you, Team 2.
Thank you. Thank you for the presentation. I'll go first with my question. One, I didn't see an analysis on the competitors. And then two, my question was on the comparative multiples. You mentioned, yes, you compared with the other banks, but there was no depth on what did you really do there. So maybe if you can give a bit of meat on that.
I'll start with the multiples. So we use the equity multiples, price to equity and price to book value, because we wanted to avoid the enterprise value multiples due to cash and debt. And because we use the price to equity multiples and price to book value multiples, these are widely used in the industry. So we used for KCB, ABSA, Stanbic and Equity, and also compared this to the industry benchmark, as well as the peers. So for competition, I'll take it over to Tracy.
Follow-up. So how did you pick an average, a median? How was it a regression analysis? How did you pick?
So for what we did we used both the peers and the industry median and did a 50-50% on the industry median and the 50% on the peers. Yes, I hope that's better. Thank you.
Thank you.
Could you kindly repeat your second question?
I missed the analysis of the competitors.
The competitor analysis was not in the slide, but as from the file we have given, we had given a sound competitive analysis by using the Porter's 5 industry analysis that gave Cooperative Bank quite a higher score.
Thanks.
Thank you, Team 2, for the good presentation. On the DDM valuation methodology, can you take us through the assumptions, how you came about to get those numbers? Thank you.
All right, so this comes from the statements first. So we used the forecasts on the GDP growth and basically had the 5% and the figures for the 2021 to 2025. Then grew our loans based on the segments. So we have the agricultural and other segments that the bank lends to. And that now fed into your net income line in the DDM approach. It also fed into, we also had a dividend line on the balance sheet that also fed there. And then we looked at tier 1 capital from the statement. So you have your beginning tier 1 capital, your net income line, less dividends, and then you have your what you call your ending tier 1 capital. So for the forecast years, we backed into our dividend line because we're able to forecast our net income, we're able to forecast the tier 1 capital as a percentage of the total risk-weighted assets, and then we're able to get basically a dividend line from 2021 to 2025, which we got its present value, and then multiplied by your price to book value to get and divided by the share price, the number of outstanding shares to get the share price. Yeah. I don't know if that answers your question.
Know how you got the risk-free rate and
yes, so we accessed beta from the Modaran, and we accessed the risk-free rate and the risk premium from Refinitiv. However, the cost of equity was computed using the capital asset pricing model with the inputs that we have, the beta, the premium, and the risk-free rate to get the 20.63%.
I'm not quite sure that she has been answered, but I think what she wants to understand is where did you get your beta from? For example, what was the basis of your beta? And then your risk-free rate, what was the basis, among others? And then maybe just another question. I'm wondering whether when you're doing your competitors analysis, you also studied that in relation to the ESG, because I'm looking at ESG and you only talked about equity wings to fly, but I'm sure KCB also does an initiative among others. So I don't know whether that was looked at also.
So I can clarify on that and answer the ESG question as well. So beta, we looked at the banking industry beta for emerging and developing economies that was accessed from Damodaran. So we had that banking industry beta. Then we, for the risk-free rate, we looked at a 5-year government bond risk-free rate on Refinitiv. They have a weighted for the five-year tenure. So we looked at that because we are valuing as at a 5-year period. So we looked for a similar period. The premium was also accessed, the equity risk premium was also accessed from Refinitiv, where we looked at Kenya's equity risk premium. They have a computation where they give you a figure on the equity risk premium, and that was our proxy for the risk premium. On ESG, I could mention that we did examine mostly on the social pillar. I looked at the Wings to Fly program, which has educated actually about 25,000 scholars, and COP follows second with the 7,000. You have KCB Foundation, which has done over 1,000 scholars. So COP standing when it comes to the social pillar is sound. I'm aware that for the competitors, probably Equity with their foundation has done quite a bit more than COP. But we believe that the ESG standing is frankly quite sound.
Additionally, also on the environmental framework, Equity had also very many initiatives in the green lending framework, but Cooperative Bank, due to the business model of cooperatives, had the better standing in comparison to Equity and KCB. Thank you.
2 questions here from Kevin. So how will GDP impact the net interest margin? Will the impact be on the interest yield or on the interest expense, and how? Question number 2, did you run any sensitivity analysis on your valuation? What KPIs have the highest impact to your valuation?
So frankly, based on the sensitivity analysis, we weren't able to carry out a sensitivity analysis at the time. Therefore, that, being honest, we did not run one. Based on the net income, I think I'd like to ask Mugambi perhaps, to give us a much more detailed explanation on the impact of GDP and the net interest income.
So we did look at our GDP growth, and then we looked at the segment growth. So if they're lending, they have agriculture, they have manufacturing, they have all those segments. So then we proxied that the growth in the loans themselves would be a factor of the GDP growth and a factor of each of the segments. So we had a long breakdown per segment and grew each of the loan segments so that we had now the final total loan figure pegged to the GDP growth and pegged to the average segment growth for agriculture, for manufacturing, for financial services over the past 5 years.
Yes, then also something else to consider was the online transactions, because COP had focused mainly on growing the online transactions even before COVID, 2019, 2020. That online transaction growth grew the net interest margin based on the transactions that are being carried out on the online platforms that COP uses. Yeah.
Okay, a follow on from Kevin. So that grows the volume, but how does it impact the margin? The net interest margin?
It increases revenue and reduces cost of the net interest margin, because as you keep on growing volume, there are more, how I would put it, there are more transactions to get more profit from. So revenues increase and cost decreases because online transactions are more efficient than the branch that COP previously had used. Yeah.
And on the traditional loan book, not on the online bit, then the cost to income ratio reduces as people become more financially stable in the wake of an increased economic growth. Yeah.
I think just to add further on what they've said, I think now we are going into a period of economic rebound. Therefore, we expect there to be a positive increase in that, as opposed to negative where we were having situations during the pandemic. Therefore, we expect a positive increase now, henceforth. Yes, you can project that.
Maybe just, thanks for your presentation. Maybe just a quick question. One of your pillars asserted that COP Bank is uniquely positioned to leverage on technology. I would like to understand a little bit more about, what makes their position unique as far as that's concerned. And then maybe the second question was towards an assertion that in terms of their credit risk evaluation, it's solid. A little bit more color as to what that entails. Thanks.
All right, so I'll take the question on the digitization of the banking. So in 2014, Cooperative Bank of Kenya integrated the Soaring Eagle Transformation Agenda. And basically, this is an agenda that has two main activities. One is to improve operations, and two is to reduce the cost. Digitization was one of those pillars, and therefore we believe that COP already since 2014 had already put in a robust and almost sound digital framework to improve, to just a sound digital framework. When 2019 came, we had, of course, the emergency containment measures that needed to be placed, and there was a quick transition from physical banking to more digital aspects of banking, and therefore we believe that the fact that they had already had these measures in place beforehand, then they were able to grow based on that. Yes.
So they had some sort of fast mover advantage when you compare to other banks because the structure was already in place. So they just needed to implement that structure. So that is how they are uniquely positioned when you compare with other banks in the region.
To answer your question on credit risk, thank you for the question, is the fact that now in light of new banking and considering a lot of Kenyans are heavily unbanked, the Cooperative Bank had stated in their credit risk framework that they're trying to look at factors that just don't look at a basic credit score, especially for new customers who have had no prior banking history. This comes into looking at things like their soft lending on things like just soft loan apps, just to be able to assess that. Also looking into their expenditure and purchasing power kind of things, which I feel is a good move and can be able to give fair credit to people. Thank you.
Thank you so much, Team 2. Let's give them a hand.
We have team 3 on stage. Your time starts now.
Good morning. We, Faith, Samuel, Sheila, Emmanuel, and I, Michael, are here to present to you the third largest bank in Kenya and the largest cooperative bank in Africa, that is Cooperative Bank of Kenya Limited, with a recommendation of buy with current price at 12.95 and target price of 15.31 with an upside of 18.2%. The key boosters are the existence of the company in the industry that is over 50 years and customers base of over 9 million accounts, membership of 15 million plus, and total asset is standing at 593 billion as of 2021 third quarter. The business description, the bank has also witnessed the tremendous improvement of the asset over time. You can see from 2000, it was 23 billion, and by the close of last year, it was over 593 billion Kenya shillings. The bank is also has covered a lot of ground within and without Kenya. It has a total of 177 branches and 479 SACCO branches across the country, 589 ATM points across the country, and 5.3 million M-COP cash customers.
On to ESG. Sorry. Okay. Can you hear me? On to ESG. We will introduce the bank first. The bank started 145 years ago, so it has some values that it has added. It has cooperative values, economic values, and colleague values for each other as the workers. Onto the environment. This is how the company is going to benefit the environment. Since 2007, it has undergone carbon neutral, and it's committed into maintaining that stance. And from 2015, all its electricity is from renewable sources. To the social, this is how the company is relating to the people within and outside. So within, from 2008, the female workers are 43%, and up to date is 46%. It also has, from to date, is 78%, and above, all the workers are below 35 years age, and it does not screen for HIV testing among the workers, which is a good thing. And we'll go to the governance. It has a group structure, which has nine groups, as you can see from the diagrams there. Then the board of directors. The board of directors, it has one managing director, one GM, 9 chief managers, and 13 section managers. Out of the managers, the CEO owns 2% of the shares, the chair owns 0.2%, and the vice chair owns 0.09% of the shares.
Now, onto industry overview and competitiveness. As you can see, Cooperative Bank, it was founded in 1965, and then it was licensed in 1968. You can see a total growth in its assets, net loans, and customer deposits, as shown in the graphs there. There are demand drivers that have propelled the bank. For example, there are issues to do with expectations of price per share, you know, when people expect the price to go up in the future, they'll tend to buy the shares as at the current price. And then you also have the availability of the shares. When it comes to supply drivers, the Cooperative Bank of Kenya has also made sure that it has brought about a lot of growth in digital channels so that it can provide more of shares. Now, anti-competitive positioning, it has established partnerships with other financial institutions. It has also has established a lot of subsidiary banks such as the Kingdom Bank and other subsidiary banks as well.
Under investment risk, we identify 3 types of risk, and that is operational risk, political risk, and market risk. Under operational risk, we identified system risk, people risk, and process risk. Under political risk, we identify political instability, particularly this being an election period in our country, it is key. And then high taxes and fluctuating economy. Then under market risk, we identify change in interest rate, equity risk, and commodity risk. Thank you.
Now, key numbers on the third quarter of 2019 to 2020 shows that return on equity increased with 12.5%, which has been projected to increase to 14.58 in 2022. The main drivers of the return on equity is a positive increase of the net profit margin, the financial leverage, and return on the asset. Now, the market share, the return on asset and the return on equity is competitive. Total assets increased at a 5-year CAGR of 11%, an increase of 17.5 in total assets, that is 2019-2020, further improved by 10.4% as at September 2021. Now, the shareholders' equity also increased by 14.4%. The loan net book increased by 7.5%, further improving by 6.6% as at September 2021. Now, in the revenue growth rate, we forecasted a 4-year CAGR growth rate of 13%, and now Coop Bank achieved a 12% increase in its revenue in the financial year 2020, resulting in a total revenue of 48,845 Kenyan shillings. This increase in the revenue was due to the approved corporate strategic plan that focused in promoting agility, growth, resilience at an appropriate time when the household and business contended with the macroeconomic issues of COVID-19. Now, on the market capitalization, we see that there was a decrease by 24.4% of the capitalization to 72.5 Kenya shillings between financial year 2019-2020 due to the unexpected invasion of COVID-19 virus. Now, Coop Bank contended with this issue with their recovery support that prioritize resilience, inclusive, and sustainable growth. The strategies included coordination with the bank, proactive risk assessments, stakeholders engagement, and now in the valuation, we did a price to book value and also a relative valuation of the bank, and the bank is right now selling at an undervalue. Thank you.
Kindly expound on your valuation.
Okay, thank you. On the valuation, the relative valuation of the cooperative bank, the bank is at the third, is valued at as the third largest bank in Kenya, and its value compared to its peers is thank you.
Do you mind talking more about the methodology?
The valuation.
Yes, the methodology you use that price to book. How did you do it so that you arrived at your 15 shillings?
The price to book valuation. Now, in the price to book valuation, we compared the market share of the value compared to
I just wanted you to, on the ESG, you had quite a bit of I don't know if we can get to the slide. You had quite a list of things you talked about ESG. I wanted you to relate them to the performance of the business. You have said a lot of nice things under ESG, but I wanted you to relate it to, the performance of the business, of the bank.
So, for ESG, for them to be able to do the 1 shilling, they have a program. It's a 1 shilling for 1 shilling per staff. That 1 shilling, every staff contributes 1 shilling. For them, that 1 shilling it goes out to help the community. So if the bank is performing well, they'll be able to give that money. Because from the, valuation, from this one, from the distribution here, you can see the growth rate is there. Give me a minute. Social or environment.
There's a forecasted CAGR of 13%. Maybe you can explain how you arrived at that forecast.
Forecasted CAGR for?
There's a slide, I think he's the one who gave us a forecast of 13%.
Now, the CAG of 13%, we took the ending value of 2021 September in the forecasted value according to the definitive workspace of 2024, and we took a beginning value in the 2021, then that value we compounded, we did it in 4 years, then we got a 13% CAG. Yeah. 1 over the 3 years, then minus 1 times 100.
On the valuation, why did you choose that methodology, the relative valuation?
Relative valuation compares the value of the bank, cooperative bank, to the value of the
Why
peers.
did you choose it?
Because it is appropriate for the bank because of its capital base.
On the same, we chose it because we are also comparing cooperative bank with its peers and want to see its position in the market.
Sorry, go ahead. Still right.
So on your, I think it was your maybe second slide under key boosters. Second slide, just keep going, yeah. The next slide. Yeah, so under key boosters, I'm just very curious about maybe number A. So existence since 1966, okay, great, that's 50 plus years, but how is that a key booster? I think about things like the global financial crisis. Banks like Lehman Brothers had been there for hundreds of years. They are no longer with us. So how do you relate that to your valuation? Just because it's been there for 50 plus years, how does that directly translate into how you valued your company and subsequently came to your buy position?
Our key focus was to look at the experience in the market, so that's why we chose to recommend it because of the existence. Because looking at the existence from 1966, it has been in the market for more than 50 years.
And on the same, being in the market for that long, we've been able to trace the bank through different economic recessions and booms throughout the year. Like 2008, there was economic recession. We saw how the bank performed, and through other issues, even now in COVID-19 pandemic, the bank has been showing some resilience and agility through those challenges. And coming to this point, we can be sure now the bank can do better in the future.
A question here from Kevin. Why do you consider CoBank as a buy? Why do you say it's a buy? We've talked about everything, but how do you summarize that?
Basically, we considered the cooperative bank as a buy because we've tried to evaluate the bank and saw the figures. The current is standing as of February, standing at 12.95, and the target price reaches up to 15.31, and this one gives us an upside increment of 18%. Therefore, we base our recommendation on that valuation.
As a follow-up, this is my own. As a follow-up, okay, there's a target price and an 18% potential increase in price. So two things: in what period do you foresee that target price will be achieved? And secondly, we know markets don't necessarily track where we believe the value is. So why do you still say it's a buy, considering those two reasons?
Please kindly pardon the second reason.
Typically don't track the values we place on the companies. There's demand and supply on the market side. So have you factored that in, considering it as a buy?
Well, we considered the first reason of increment, and this increment is the one that led us to, and we have focused on a period of the year. At the close of the year, the value shall stand at 15.3. So that's the period we've considered.
Also, considering the political risk that we have this year in 2022, in the electioneering period, the price may come down because of the risks of the electioneering period. But after the elections, we're focusing the price to come to 15.3.
And also on the same point, we know and we understand there are market risks that are involved. There are systematic and unsystematic risks are involved in all this. But even looking at the history, since 2007 and even during the elections, whatever thing was happening, there was a recession that was there. But after that, we saw an increase in the shares, or in the way we can value the bank. So looking at the history also, we can say it's true. It's true, we can put it as a buy and expect a good thing from it. Thank you.
Question, when you go to your risk slide, yeah, so you outlined those three risks. I'm just curious, you're dealing with a bank here, an institution whose key job is to lend money to various institutions. Did credit risk not seem a worthy risk to consider as well, or what was the rationale for leaving it out? credit risk. Why is credit risk not among your three types of risks that are identified? It's a bank, after all.
Okay, our focus first, when we go back to our recommendation, one of the key things was about the staff and the employees, the customers. So one of the key risks was to be operational because it connects with them. So we wanted to check first how effective are they when it comes to their presence in the bank, and how well are they taken care of. So we wanted to first focus on operational risk. That's why we gave it that first priority. Then when it comes to political risk, as my brother has explained, this is that period of the year where, as a country, and being in a position where we are talking about cooperative bank in Kenya, we had to focus on it because we are heading to that period. It's just a matter of 6 months from now, and we'll be there. So we wanted also to check, how will the bank be at that time? Can we recommend someone to go ahead and, get a buy from it? Same to market risk.
Yeah, and the credit risk we classified under the market risks because the market, we are looking at it at a macroeconomic level and microeconomic level that will capture the credit risks within. So we have really considered it under the market risks.
And for the credit risk for not it being there, we did like this. It's operational, political because it's almost the political time. Then the market risk is because of the COVID. Then we factored the credit in the market so that it can incorporate everything together. Thank you.
Thank you very much.
Thank you, Team 3. Team 4, your time starts now.
Thank you. Good morning, investors. My name is Vanessa Momanyi. Joining me today, I have Rerimoy Caroline, Michael Gisheru, and Albert Akinyi. Welcome to our investment presentation on Cooperative Bank. After performing company evaluation, we derived a target price of 16.29 Kenya shillings, which represents an upside of 25.79% on the current share price as of 12th January 2022. This leads us to issue a buy recommendation on the holding. The key 4 investment drivers behind this decision is Kenya's positive macroeconomic outlook. According to the IMF, Kenya has a forecasted real GDP of 6%. The GDP is the measure of a country's economic output, meaning the larger the GDP, the more goods a company produces, which encourages consumption and spending. This in turn necessitates borrowing from banks and is beneficial to Cooperative Bank. We'll look at the strong local brand of Cooperative Bank. The bank's decision to double down on Kenya, only expanding to South Sudan, has made the brand a household name. Also remembering that Cooperative Bank was formed by cooperatives. Next, we'll look at the favorable government regulation that the bank enjoys. Kenya, the government has maintained an interest rate of 7%, which is the lowest recorded ever in Kenya. The low interest rate the government is foreseen to maintain the interest rate at 7%, which means that more people will be encouraged to borrow. We'll look at the strong financial soundness of the bank, where my colleague Caroline will take us through that.
Okay, so thank you, Vanessa. So I'll take you through the financial analysis, specifically the CAMEL framework. And to begin is the capital adequacy ratio. And for cooperatives specifically, they have a satisfactory capital adequacy ratio. And this is why. So in the year 2020, they had a rate of 16.99%, which is above the minimum rate for CBK as indicated there. However, I should note that even though they had a rate higher than the CBK, cooperative from the previous year in 2020, they had a rate of 23%, which they decreased in 2020. And the reason behind this is because cooperative acquired Jamii Bora Bank, and in result, they have not had the time to show up their capital reserve. So the second ratio is the asset quality. And in contrary, they have a deteriorating asset quality. Specifically in 2020, their rates significantly increased from 4% to 18.7%. The reason behind this is because the non-performing loans increased as a result of COVID. We are all familiar with the pandemic. Yes, so cooperative is hoping that post-pandemic, they'll go back to the ratio with a decrease in non-performing loans. Finally, I'll go through the management team. So cooperative has a strong management team with strategic plans for long-term growth and ways to mitigate any unexpected risks. Thank you. I will invite Michael to continue on financial analysis.
Thank you, Caroline. I'll be going through the liquidity for the bank. Go back. So we can see that it has a decrease in but good liquidity. Its current ratio has been diminishing since 2016. So this can be explained because the bank has been focusing more on long-term investments. A good example would be Jamii Bora's acquisition, cash acquisition of 1 billion, as well as joint ventures with cooperative societies in markets of interest, such as South Sudan. Moving on to the earnings. The company has sound earnings. Since 2016, after the interest rate cap, the bank can be seen adjusting to the interest rate cap that was set by the government, and net interest margin has been growing since then. However, we expect this to continue with the removal of the interest rate cap and post-pandemic times. On the other hand, it has diminishing return on earning assets. However, in 2017 all the way to 2019, it was on the recovery, only the pandemic being a black swan event affected the recovery. We expect the trend of recovery to continue post-pandemic. So we also find it prudent to note the effect the upcoming elections might have on the company's financials. As you can see, from our forecasts, there's a slight dip in revenue and profits from in the company's financials. This is merely due to speculatory factors rather than an indication of a company that is ailing. Moving on to valuation, we employed discounted cash flow valuation, mainly discounting free cash flow to equity. Our assumptions were a cost of equity of 21%, as well as a terminal growth rate of 6%. So we arrived at a 16.29 shilling per share valuation, weighted with 100% weighting. Moving on, so in our scenario analysis, we found that the stock exhibits low volatility. As you can see, the range is barely 2 shillings. So whether good or bad, the company is healthy. The company's share price is healthy. So this can show that it can be considered a very safe investment. Moving on to relative valuation. So we compare the PE ratio of the company to industry averages. So from 2019, we can see that it has been on the recovery it has been going up in a time during industry averages have been going down. In other key financial ratios, next. So in other key financial ratios, we employed a ranking system. So in each category, 9 being the highest, accumulating to a total of 45. Coop Bank scored a 25, which is right in the middle of the pack. So 25 out of 45. This can be seen as more positive than a first glance can show. This is because, as you can see, it's up against Equity, KCB, Absa. These are companies that have diversified to other markets, and Coop Bank only relies on Kenya as its main income driver. So, and South Sudan, which is still a loss-making business. So it's more positive than it actually looks. So yeah, I would invite Albright to go through our ESGs.
Thank you very much, Mike, for that. Moving on to environmental, social, and governance matters, the company has numerous funding initiatives in this regard. For instance, it has a $10 million partnership with Eco Business Fund, where it aims to finance sustainable agriculture. It also has a $75 million partnership with IFC. Here, it hopes to support its customers in dealing with the COVID-19 pandemic. Moving on to environmental initiatives, the company has green lending. It also has the reduce, reuse, recycle initiative, where, for instance, envelopes are reused within the company. It also has ecosystem services. For instance, they banned the use of the prohibited R22 gas, and they're now implementing the use of greenhouse gases in their air conditioning equipment. The company has reduced its emissions, and they comply with regulations. They also practice eco-efficiency. For instance, they have tree planting initiatives. And lastly, they take part in direct management in their energy activities. For instance, they have an energy management policy statement, enabling them to comply with the regulations that have been set in the Energy Act of 2019. Looking at social investment and social responsibility, in terms of social investment, the company has the Cooperative Bank Foundation. In terms of social responsibility, it ensures that it does not discriminate against persons with disabilities, and it also has employee diversity. Lastly, looking at corporate governance, as earlier cited by Caroline, the company has a strong management team, and the board of directors that is in charge of corporate governance ensures that the company complies with the regulations that have been set by the Central Bank of Kenya. Reputable reviewers have given the bank high ratings, leading to various awards on the same. Clearly, we can see from all these ESG initiatives that the company cares for those it works for and works with. Knowing the positive outlook that is there on the ESG market, we maintain a stand on giving a buy recommendation on the bank. I'd like to hand over to Vanessa to conclude.
Thank you. We open the floor to other questions.
A good presentation. I have a question, follow up on your valuation methodology. You said that you used, did you say that you used DCF? And what was it about the relative valuation? What was that slide about? Were you just telling us about? You used DCF, but then you went on to talk about relative valuation. Yeah. Yes.
That's against. We use that against the industry average. So we thought.
The value using the relative valuation methodology.
Oh, okay. Don't take it as.
You didn't.
No.
So the value is only the DCF.
Yeah.
This was just for you to just see where they lie.
Yeah, exactly.
Okay. Thank you.
Good morning. I have a question for you on the prospects of the bank beyond Kenya. It's pretty competitive here. What are your thoughts about whether they're looking at a blue ocean as opposed to what's just here?
Okay. So, as you probably all know, recently Ethiopia opened up its markets to foreign banks. Cooperative Bank has expressed an interest in going in there as a joint venture with its cooperative societies. We saw a figure of 14 million members of cooperative societies. So with them being a joint venture, they are assured of business in cooperative societies. So yeah, it's pretty good for them, looking pretty good for them and their business model. Yeah.
Just a follow-on on that. Ethiopia has just opened up. The other cooperative movements on the continent, how come they've not pursued that there?
As you have said, one of the investment drivers was establishing a local brand. So they have been working towards making Cooperative Bank a household name here. And we can look at the agents that have been starting up. There's Kopmtaani, whenever you step out. So they were making sure they have the largest presence here before venturing into foreign markets.
Some questions from Kevin here. One, why was your analysis focusing on 2016 to 2019? I think there are some 2 years there, especially given COVID happened 2020 and 2021. And then why did you utilize a DCF model instead of a discounted dividend model?
Okay, so I'll answer the second question and why we chose DCF in comparison to the DM. So as we know, cooperatives usually give dividend every single year. So if we choose that model to be able to value our company, it would show things like unexpected changes as COVID, as elections, as just any upcoming things. So we saw the cash flow method was better off. Sorry, could you repeat the first question? First question.
The first question was why did you utilize 2016 to 2019 financial period and not factor in the 2020-2021?
We did. 2020 to 2021 is there in our forecast. If- Next one.
It's lost.
It's here.
Yeah, so from 2019.
Just go one slide back.
Okay. Oh, you mean this one? Oh, that was a mistake on our part. We only noticed after sending the slide.
Okay, so for me, my question. So for me, my question is on competition. How do you position Coop Bank in relation to not only the local but regional competition? Yeah.
So, Coop Bank is, well, I would say Coop Bank is the third largest bank by assets in Kenya. And it has, its decision to double down on the Kenyan market has been sort of prudent. And so we all know, like, we are you, that, like, first of all, most of us grew up with Jambo Junior accounts. So in the end, most of us have cooperative bank accounts. So, and also we all know it's branding of We Are You, Coop Bank. So in terms of branding and putting its name out there, it's up there with the rest of them. And it should continue to be that way. So yeah, it also, like, as everyone is going towards a digital economy, we have the MCOP Cash app, which is pretty good in our opinion. So yeah.
Another question from me. On your valuation, you said your cost of equity was 21.6.
Yeah.
And the return on equity for the bank may not be more than 20%. Is that right?
Oh. Yes.
So why would I invest equity at a cost of 21.6 and only earn less than 20?
That's a very good question. We did not factor that in when you were taking into account our cost of equity. Yeah, that's all I have to say on that.
Thank you so much, Team 4. Let's give them a hand. We'll be taking our tea break at this juncture, so stretch your legs, interact, and then we can proceed with teams 5, 6, and 7 in the next 15 minutes. Thank you. everyone please settle down. We have team 5 on stage.
Okay.
Your time starts now.
Okay, all protocols observed. Good afternoon. Okay, to start
Excuse, hold the mic to your face.
Okay, to start with, I would like to introduce this team. This is team 5. Okay, my name is Jackson Kaido. This is Douglas. That is Nefat. So, I'll start by a brief description of the company. So, the cooperative bank was formed in 1968. Then in 1994, it was fully converted to a commercial bank. In 2008, it was listed at the Nairobi Securities Exchange. In 2009 to 2013, it underwent a rapid expansion. 2014 to 2015, it embarked on the Soaring Eagle agenda. So the Soaring Eagle agenda, it was a transformation initiative which mainly focused on growth and efficiency. In 2019 to 2020, it showed great resilience in balance sheet growth and became the third largest bank in Kenya with a profit before tax of 14.3 billion. So again, I look at the financial growth. Looking at the financial growth, we looked at 4 items. That is total assets, the loan book, customer deposits, and the profit before tax. So the total assets, we looked for the past 5 years. So the total assets they increased from 387 billion in 2017 to 593 billion in September 2021. The loan book, it increased from 254 billion in 2017 to 306 in September 2021. The customer deposits, they increased from 287 billion in 2017 to 420 in 2021 September. Profit before tax, it increased from 16.4 billion in 2017 to 20.7 in 2019 and 16.5 billion in 2021. So Nefat will take us through the financial analysis and the historical financial performance and the forecast of future performance.
Yes, Mon, as you've heard, you are Team 5 and I'm Nefat, taking you through the financial analysis. And this section briefly, we majorly analyzed the historical financial performance and the forecast of the future performance of cooperative bank. And in our analysis, we measured on following key ratios, which is profitability, efficiency, market-based ratios, solvency ratios, and liquidity, as well total assets to total equity ratio. So I will begin with the profitability ratio. Profitability ratio, we used the return on average equity and return on average assets. And as you can see, we compared between quarter 3 2020 to quarter 3 2021. And as you can see, the return on average equity increased from 16.6% to 17.2%. This implies that there is an increase in asset efficiency, whereby the company now is, this shows that the company is able to earn more money with a smaller investment. The return on average equity also increased from 2.5 to 2.5 to 2.8%, which is a 0.3 increase. This implies that the the company efficiently uses its shareholders' equity to generate income. The next ratio was the efficiency ratio, whereby we considered the current asset ratio and the assets turnover ratio, whereby we realized that the current asset ratio increased from, the current asset ratio has increased from 1.35 in quarter 3 of 2020 to 1.39 in quarter 3 of 2021, which means that the company is more capable of paying its obligations. So the next was assets to turnover ratio. Also, there was an increase in assets turnover ratio, implying that the company is more capable of more generating revenue from its assets. The next ratio, that is the third one, was market-based ratios, where we realized there was an earning per share, whereby earning per share reveals to shareholders how much money their shares have earned for the company. So we realized there was a 2% increase, implying that the company is earning more profit to distribute. There was an increase in earnings of profit to distribute to the shareholders. The other ratio was the solvency ratio, and we used the equity multiplier and the debt asset ratio. There was an increase of 0.01, and this implies that the Cooperative Bank of Kenya has a higher level of debt. The next was also an increase in debt to asset ratio by a ratio of 0.02, which indicates that a considerable portion of the company asset is not much funded by debt. The next was a liquidity ratio, whereby there was also an increase, implying that the company is in a better position to meet its obligations as well, total loans to total deposits. We realized that there was a decrease, which shows there was an improvement of liquidity to cover the unforeseen requirement. And the last one we used was loans to deposit plus borrowings of funds, which indicated the company improved in balancing the loans. The next is a valuation method, which my colleague Douglas will take you through.
Yes, good afternoon. I'm Mosiri Douglas, and I'll be taking you through the evaluation method. And under this category, you try to focus on cooperative bank valuation, both equity and the asset. We use both the asset approach method and the market approach method, whereby under this valuation we used the conventional valuation metrics and formulas which we used to value the analysis. Both were based on the financial statement analysis, as my brother has taken you through, and both the equity valuation models we also used them to derive the relative values. Yes, starting from the asset approach method, as from the quarter of the year 2020 and 2021, it shows that there was a slight increase in the percentage of the assets approach in the company, showing that the company, the cooperative bank company, is in a well position due to it's in a fair position, and due to the fair value of the company. That's showing that the company's assets are well utilized by the cooperative bank. Coming to the market approach, whereby used that the price to earning ratio, we show that there was also an increase of the price to earning ratio, which indicated that it improved to 53% from the prior years. That indicating that the value of the company with similar assets based on the metrics is also on a better position to the company. And also looking at the price to sales ratio of the company, the investors are not much willing to pay a higher rate of, a higher share price. This is due to it shows that the price to sales ratio, the prices were high. Yes, it shows that the prices, the share price, yes?
Time is up.
So I can do a quick conclusion. Looking at the current market price per share as of today,
Your 10
it is
minutes
trading.
are up. Your 10 minutes are up. It's now time for Q&A.
I didn't get from the presentation, it seemed more of a comparison or comparison of performance than understanding the valuation. So I see the market approach, the asset approach, but I'm still not gotten how you determine the valuation.
Okay, we were comparing the previous quarter for 2020 and the quarter 3 of 2020 and quarter 3 of 2021. So that now we can be able to predict the future of the company.
Was that the next slide, the prediction? And for how long were you predicting?
So, according to our slide, the next presentation was, we mostly focused on the quarter 3 and quarter 4 of 2021, because we showed there was a slight same correlation with the previous years, because there was a slight increase. So you looked at the previous, that's the comparisons of between different years, but you managed to, we only looked at the main quarter 3 of 2020, of 2020 and 2021.
And
Because he said that you were going to predict.
yes, in addition,
I just wanted to know whether you were caught out by time and you have done the prediction, or you didn't do the forecast.
he was to do the forecast, the future
So
forecast.
was it there in your presentation, if you had time?
Yes.
Is what I'm asking.
Yeah.
Was it there? Did you have a forecast if you had more time?
What was to guide us to do the forecast was the...
Go to the slide.
So is it there in your slides or not?
No.
Okay, thank you, thank you.
Sorry, a question from Kevin, as Richard prepares. What does a price to earnings ratio mean to you, and why is the growth in the price to earning important to you? Is it meaningful? That's the first question. The second question is, do you feel the differential comparison in 2 quarters is sufficient to make focus of the company? And I think that comes to almost what you're being asked there also. So those 2 questions.
Okay, knowing the price per earning ratio, it is important, especially for an investor who wants to invest in a company, so that now you can be able to look at the history of how they have been performing in terms of the earnings that they have been generating, and also in addition to the earnings per ratio, you are supposed now to look also at the dividends per share, so that you can be able to make a decision of whether to invest or not.
And for the next question, let me try to answer about if the 2 quarters were enough for the future forecast. Briefly, what I can say is that those 2 quarters maybe can be those 2 quarters can be much important for those who want to invest, short-term investors. But for long-term investors who want to invest for a long-term period of time, a more analysis can be done of maybe 5 quarters, something like that. But for the investors who prefer a short-term period of investment, they can, I think 2 quarters can make a green light for them.
Thank you. Jackson, your first slide told us about the history of Cooperative Bank, and it showed that the cooperative movement has 64% shareholding in the bank, and you said it's a strategic holding. How does that shareholding assist the bank, Cooperative Bank, to operate successfully?
I think now that comes in where there is now the majority shareholding and the minority. Now, how now the earnings attributable to their shareholders will be shared among the minority and the majority shareholding.
And what I mean is there a benefit to having that strategic shareholder? Has Cooperative Bank benefited in any way?
Yes, in addition to that, I can say that there is a benefit because they are the major shareholders with a 64% shareholding. So I can say that they are benefiting a lot from the, let's say maybe during the time of payment of the dividends, the company, the cooperative society is more considered first. It's given the first priority because it owns a maximum number of shares compared to the rest shareholders.
Thank you. Let's give them a round of applause. Yeah. Team 6. Your time starts now.
Good afternoon, all. This is Team 6. I am Sami. He is Derek, Mark, and Damaris. And we're here to present on the largest cooperative bank in Africa. Welcome, Mark.
Thank you, Sami. So we recommended a buy of 15 Kenya shillings. This represents upside of 15.38% from the closing price of 13 Kenya shillings. This has been met by the growth potential that Cooperative Bank has. One of it being a dominant bank in providing solutions to the cooperative divisions, SACCOs. The other one is pursuing cost rationalization, digitalization and innovation. Project 3C, the connect, collect and cure, driven by the motive of decentralizing the loan portfolio, and also revenue diversification. This growth strategy is anchored on the strong governance structure. This is led by the 15 board directors. The directors were very efficient, and they're being led by the CEO, Dr. Gideon Murioki, who has been in the banking sector for around 32 years with experience, and has also been the CEO of Cooperative Bank for the last 21 years. So he's capable, and he has led the team very well to its margins until now. The other thing is a strong capital structure and high liquidity ratios, a growing return of equity and dividends. Now, Cooperative Bank is the largest cooperative bank in Africa, housing over 15 million members. It's also a dominant bank in Kenya, up to a market capitalization of around 74.5 billion. And it's also growing, agile and resilient bank with high levels of operation efficiency. At the same time, it offers integrated universal banking model. Banking models, Cooperative offers services. It offers a wide variety of services to its customers. For example, retail and banking services, cooperative banking, funds under management, consultancy, stock brokerage, and insurance brokerage. Now, under competitive analysis, under competitive advantage, Cooperative Bank has been able to survive among its peers because it's one of the banks that houses the most SACCOs in Kenya. It houses up to 3,800 SACCOs, and also it offers customer-centric solutions over its peers. And also, we use the Porter's 5 forces of competitive positioning analysis to understand how Cooperative is positioned in its environment. And competitive rivalry, high, we dictated a high, due to many competitors. Supplier power, we dictated a low, due to the large numbers of suppliers chosen from. Buy power, it also low, because of the high numbers of buyers who are unlikely to dictate the prices. Threat of substitution, high, due to the many peers dwelling in the same thing. Threat of new entry also low, because of the stringent guidelines by the CBK. Now, I'll welcome Derek to take you through the financial analysis. Thank you.
Okay. Based on the growth in interest income, the growth in the net revenue growth of the company, we issued a buy recommendation with a target price of 15 shillings, representing at of 15.38%. This is based on the net. We have seen that the bank has seen a net revenue growth from 15.5% to 15.5%, and also the net interest margin of 30.2% increase. Okay, so we are going to analyze on this first on loans and advances. We see that the bank has a 5-year CAG of 6.6%, and also the year-on-year change on loan book on 7.8%. We also take a close look on the loan diversification. The bank has been able to diversify on its loan book, offering loan services to various to its customer base. It offers various types of loans to its customer base. Okay, the bank has also been able to realize a growth in total assets from 2019 to 2020. The bank has been able to realize a growth in with a year-on-year change of 17.5%, from 536 billion, from 457 billion to 536 billion total assets. Profit after tax has seen also a growth from 2019 to 2020, with a profit after tax of, before tax of 14.3 billion. On the non-performing loans, the bank in the year 2020, it saw a high growth in non-performing loans, but based on the quarters, on the third quarter, the third quarter of 2021, it saw a decline in the non-performing loans from 13.9% to 13.90, from 13.92 to 13.90. Okay, so on the liquidity ratios, the bank has seen a high liquidity ratio of 52.2%. Cost to income ratio is also high. We also did an average of ROE, which represent 12.7%. Non-funded income, it rose from the third quarter of 2020 to 2021. We saw a decline in the non-funded income for the bank from 36.5% to 35.40%. Based on the CAMES rating, the bank has a high capital adequacy ratio. The earnings quality, they are quite well performing. The liquidity ratios are high, and also the variation of the company. On the variation of the company, we use the relative variation model. Then we used the relative variation model to value the relative variation of the company. Price to book ratio was used because it gives a clear estimate of the growth of the bank in the book equity.
So on the investment risk, based on the likelihood of occurrence and the impact that the risk can cause, we have the foreign risk, we have the credit risk, we have the market risk, we have the operational risk, we have the interest rate risk, we have the exchange rate risk, we have the operational risk, and we have still the compliance risk. On a way of minimizing the risk, the Cooperative Bank came up with a management process which included the following process. One is the risk profiling, then we have the risk identification, the risk assessment, and lastly, we have the risk monitoring or the risk mitigation. Other ways of minimizing the risk included the adherence to the CBK rules and regulations. We have the end-to-end assessment of the credit, mostly of the credit risk management. We have where we have the correction, where people enhance corrections, and the last one, it's strengthening the portfolio and the portfolio management and the risk frameworks that are in place. I now welcome Damaris for the next part.
The next part is the ESG, which is environmental, social, and corporate governance. Under environmental, Cooperative Bank of Kenya has ensured that it has participated in the minimization of waste through going to paperless work by adopting the social media platforms in the registration of through the registration. Under social, they have ensured they have involved the people with disabilities who have a 0.40%, and women have 0.46%, and men have 0.54% in the employment. Under corporate governance, we have 15 members in the board. 3 of them are women and 12 of them are men. 14 of them are non-executive, and 1 of them is executive, who is the CEO, Gideon Murioki. Gideon Murioki has 2% of the shares, while the chairman, MacLeod Malonza, has 0.09% of the shares. I now welcome Samithawa to take us through the SWOT analysis.
On the SWOT, the opportunities. We have the expansion of the bank. We have the expansion of the banks.
Sorry, your time is up.
Good morning.
Oh, is it afternoon? Yes, good afternoon. Sami, you told us about the 5 forces. Was it Mark? It was Mark. So you talked of the 5 forces, and there's only one which stood out as a strength for cooperative bank, that regulation disallows entry of, new banks. So if 4 of the 5 forces are not supportive of the bank, does that make this a compelling investment? So you have 5 of the Porter's forces, and only one is beneficial to cooperative bank. Should we be concerned that the industry as a whole is not a competitive one to invest in?
We are not supposed to be concerned a lot, because you see, for cooperative bank, it has reached where it has because cooperative has diversified its portfolio in the sense that it has really invested so much into SACCOs, and it's one of the largest banks in Africa because of investing so much into SACCOs compared to its peers. Yes.
Let me ask you, regarding the growth strategy, you identified low operating costs as one of their growth strategies. Please comment more on that. How did you identify they have low operating cost?
The bank has low operating costs in terms of in seeking revenue for the growth. In terms of growth potential of the bank seeks to have a low cost of capital when seeking fund to invest in the bank. So, for example, when the bank tends to seek funds for investment in other areas, it tends to seek funds from maybe the Central Bank of Kenya. Or other areas where the bank can see there's cheap costs in the bank.
Also, with the adoption of the 3 Rs, retaining, reusing, and recycling, they are able to minimize costs because they use paperless in most of their banking. So the cost that is used is minimal.
Data support that?
Okay. On low cost, the best one is about the expenses, the total expenses of the bank are lowered through making sure that the general level of participation is made to be at the level best, the lowest in all ways that they are doing.
Some questions from Kevin. Number 1. Why do you think a high liquidity ratio is good for the bank? Number 2, why did you opt to use a price to book instead of a price to earning multiple? Given the high liquidity of CoopBank and the higher cost to income ratio, what other considerations did you take into account when using a price to book multiple? Maybe I'll repeat, that's such a long question. So number 1, why do you think a high liquidity ratio is good for the bank?
The price to book value, it gives a clear valuation of the company in terms of the prices, because it gives us a historical price. It helps us to understand the banks from an historical point of view. It is based on the expected growth in the book entity in the book equity of the company, the price to book value. When we are considering the price to book value, we also took into consideration the book value of the company, the book value per share of the company, which represents 16.62 shillings. Also, we also next question, please.
I guess that would be the first then. Why do you think a high liquidity ratio is good for the bank?
A high liquidity ratio is good for the bank because it helps the bank to remain solvent, solvent in the case of the bank liquidation.
Just a follow-up. A bank's business is lending, right? And
Pardon?
pretty much financial services.
Okay.
So why would they sit with a significant amount of that money instead of lending?
Come up again.
A bank's main source of income is lending, right?
Yes.
From lending. So why would they sit with that much funding and have a high liquidity ratio instead of lending it?
For the bank to sustain a high liquidity ratio, if that's what you're asking, for the bank to sustain a high liquidity ratio, the bank, as in a cooperative bank, also can invest in more liquid assets to ensure that it retains its high liquidity ratio. More liquid assets in form of maybe investing in stock prices, also investing in stock prices and investing in government securities, which are more liquid.
I have a question on, okay, I would like you to talk a bit more about where the bank stands in terms of competition, in your view. Competition, competitors.
Okay, so Cooperative Bank, as I've already said earlier, it's the third, it's a dominant bank in Kenya. It stands third in its market with a market capitalization of 74.5 billion. It also has a free float of 765.66 million shares. So Cooperative Bank, being a bank that invests so much into, it has really invested so much into SACCOs, and its peers, they have an advantage over their peers because they have invested so much into SACCOs, and their peers are not so much into SACCOs. So Cooperative Bank has thrived because of investing so much into SACCOs. And also it offers the...
Who are these peers?
Yeah?
Who are these peers?
Yeah, for example, we have the KCB, the Equity, the banks. So, and also KCB, and also Cooperative Bank offers customer-centric solutions in the sense that it is shifting its approach in terms of digitization and innovation. It is moving to the digital world. Right now, Cooperative Bank, you can transact using your mobile phone. You can also transact through the internet. So we are moving also on the digital platform. Yes.
Good afternoon. You had mentioned a CEO who's been there for a very long period, 35 years. You mentioned 35 years, I think, with the bank, and then 21, yeah? 32 years, yeah, and also 21, I don't know, in the banking industry. Yeah, you mentioned quite a long period. But I was wondering, if assume today he left, how would this really affect? Because is it important for this CEO to be there for this bank, this recommendation to be a buy, or how does it affect the banking operations?
Okay, so the CEO, Dr. Gideon Muriuki, has been there as the CEO from 2000 to 2001 up to currently, and he has been also in the banking sector for the last 32 years. So we see from that he has a very high experience in terms of the banking sector, and he has really done a lot for the bank. Right now, if you say the CEO gets out, the bank will still sustain because the directors that are there, they're very efficient, and they also have experience. They have been with him, and the others who are coming in, and how the bank is shifting, it's also a good, that's why we recommended a buy. Yes.
Thank you. Team 6, let's give them a round of applause.
on stage we have Team 7, our final team for round 1.
Good afternoon, ladies and gentlemen. Before you is Team 7 and my group members, Irene Zai and Matthew Wamboi. Sorry? Is it better? Yes. Okay, I'll start again, sorry. Good afternoon, ladies and gentlemen. Before you is Team 7, and our group members are Irene Zai and Matthew Wamboi, and my name is Obed Matara. So we initiate our coverage on the Cooperative Bank of Kenya based on a 12-month target price of 15.3 Kenyan shillings, which represents a 17.7 upside from the last close of 13.0 Kenyan shillings. Moving forward, a brief description of the company shows us that the main income drivers are interest income and non-interest income, with the various key drivers as seen from the slides. Moving forward, a brief overview of the regional presence shows us that the bank has a stable footing in South Sudan, with the subsidiary being the Cooperative Bank of South Sudan, and the other subsidiary in Kenya being the Kingdom Bank based here in Kenya. The bank has 8.8 million customers with over 4,000 staff members. Moving forward, we'll take a brief overview of the industry, the banking industry in Kenya. The banking industry in Kenya can be said to be highly competitive, and the banking industry in Kenya has experienced a steep growth in profits for over the last 10 years, with the key demand drivers as shown on the slides and the supply drivers as highlighted in the slides. Moving on, a look at the competitive positioning. We highlight two key factors, the first one being the close relationship that Cooperative Bank has with its consumers. And this can be exemplified in the way that the bank restructured its loan book for a total sum of loans of 49 billion. And this just shows that the bank has a close relationship with its consumers, and it tried to ease the financial burden the global pandemic had on its customers. The second factor is the growth sustained by strong capital buffers. Now, Cooperative Bank has strong capital buffers that we found to be really agile and resilient even through the pandemic, and it was actually the only bank that was able to issue out dividends to its shareholders, and it was actually also commended for being the only bank to retain its employees even through the turbulences caused by the global pandemic. Moving on, we take a look at the ESG, and I invite my fellow colleague Mercy to take us through it.
Thank you, Obed. Thank you. So, Cooperative Bank attempts or strives to promote eco-efficiency and sustainability through its operations. So we'll begin with the environmental bit. So Cooperative Bank has made significant investments towards energy efficiency. And to do this, it has come up with an energy management policy statement, which ensures that the bank is able to manage its energy costs sustainably and efficiently. So the bank also offers green lending, so it lends to initiatives that promote environmental conservation. So we'll also tackle the social bit. So Cooperative Bank in 2007 founded the Coop Bank Foundation, and through this, the foundation is able to sponsor needy and bright students. And over the years, the bank has been able to fund to a tune of about 1.18 billion Kenya shillings, and it has supported about 8,638 students. So the bank also promotes gender and cultural diversity. So the bank has a 46% to 54% ratio of women to men, and this shows that the bank continues to promote gender diversity among its staff. So for the governance part, we conducted a corporate governance scoring, and with this we were able to obtain a 96.3% corporate governance scoring for Cooperative Bank. This shows that Cooperative Bank has a strong and able corporate governance that will be able to steer the bank forward to attain greater heights. We'll now invite Obed to take us through the investment summary.
Thank you very much, Mercy. And moving on to the investment summary, please, next slide. Next slide. Thank you. At this point, ladies and gentlemen, we reiterate our statement for the buy recommendation, which are supported on the following merits. The first one being that Kingdom Bank shows signs of profitability in the future, and the bank has actually shown an improvement of returns by over 100.5 from its previous record, and it continues to segment itself into a more profitable and sustainable zone. Looking at the second point, the bank is spiraling its revenue drive based on the soaring ego transformation agenda. And this agenda was launched by the bank with the initiative of putting it at a stable competitive position in the Kenyan banking industry. And true to this, the initiative has had key achievements. For example, there has been a 93% shift of transactions from to alternative channels with a key focus on e-credit. The third point is the approval of Cooperative Bank's risk pricing model. We expect the Central Bank of Kenya to approve the bank's risk pricing model, and the effect of this is that it will have a gradual increase on the ROE. Also, the net interest margin will increase from 7.5 to 8% in the next 5 years. The last point is the investment in e-credit, and Cooperative Bank has had successful penetration of e-credit products such as e-flex in the market, and this is quite commendable. One demerit, though, is the fact that the joint venture in South Sudan has caused a lot of talk because of the inflation in the country. However, we speculate that the economic environment in South Sudan will stabilize in the future. It is also key to note that in spite of this, the post-pandemic returns in South Sudan subsidiary were actually higher than the pre-pandemic returns. Moving on, we'll take a look at the financial analysis, and I invite Irene to take us through it.
Excuse.
Our first assumption is on the ROE. So we expect the ROE to increase from 12.7% to 16.1%. And why are we saying it's going to increase? The main reason is because, number one, the income is increasing at an average rate of 8.9% annually. Secondly, the soaring eagle transformation agenda, as suggested by my colleague, is a key driver of value in the bank. So our second assumption is on the operating expenditure. In 2020, the operating expenditure increased. It was very high, mainly because of the COVID-19 pandemic. The bank had to buy new equipment to keep up with the regulation. However, we expect it to decline in 2021 and increase onwards at a rate of 6.9% annually. Our fourth assumption is on deposit and loans. So we expect loans to grow at a rate of 7.4%, we expect deposits to grow at a rate of 7.4%, while the loans are growing at a rate of 6.6%. You will notice that the deposits are growing faster than the loans. But this is a sign that the bank can actually lend more, which means that it has a high potential of actually becoming more profitable. So our fourth assumption is on the NPL, and our forecasts show that the NPL is going to go down to 8% by 2025, and this is because we expect the economy to stabilize after the pandemic. Our fifth assumption is on the operational efficiency. So as stated previously, the bank is moving towards the digital side, so we expect the cost-to-income ratio to decrease to 50% in the financial year of 2025. You should also note that Cooperative Bank has one of the lowest cost-to-income ratios, which is a good thing. So all these assumptions were put into our financial analysis, and we came up with those ratios. So next, we go to the valuation. We had two methods. We had absolute valuation and we had relative valuation. Under absolute valuation, we had the DDM, and under relative, we had the multiples. So for the DDM, we had a risk-free rate of 11%. This is the 5-year bond yield in Kenya. We also had the risk premium of 6%, a beta, and a cost of equity that were calculated using CAPEM. We also had a growth rate of 8% and a terminal ROE of 16.1% that was taken from our financial analysis. So our multiples, we had 8 banks, and we had an intrinsic value of 15.2 Kenyan shillings. You should also note that in the DDM, we had an intrinsic value of 15.5 Kenyan shillings. So we applied a 40-60% weighting on the DDM and the relative valuation, and this gives us a price of 15.3 Kenyan shillings, which when compared to the closing price, the company is undervalued. Therefore, we offer a buy recommendation. So now I'm going to invite Mercy to take us to investment risk.
Okay, so for the investment risk, so we identify valuation risk, market risk, and operating risk, together with political risk being the main risks. With the valuation risk, we conducted a Monte Carlo simulation with 83.1% of the time.
Sorry.
Thank you. We now welcome any questions.
I'll go first. Two questions. Number one, what terminal growth rate did you use? And then number two, on the comparison, why did you use the median and not regression analysis, which would have factored in the impact of ROE on price to book?
First of all, I will tackle the terminal growth rate. So we opted for a terminal ROE because we know the ROE gives us the value of the company. So as of 2025, the ROE was 16.1. So instead we used that with the share price to obtain, with the outstanding shares to obtain the value of the company as of the year 2025.
Just follow up on that. That's a new one for me. So how did you apply the ROE to determine the value again?
We applied the ROE, the terminal ROE, because we saw it was a more definite way than going again and creating another assumption. You see, when we create another assumption, it creates more uncertainty. So we decided to use the terminal ROE that we had already calculated to fit into the DDM model.
You schooled me on that. And then the other one on the median?
We decided to use the median and not the average because when you use an average, really, and you have extreme values, then it can really alter your results at the end. So we decided to go with the median.
Well done. I think your presentation was very, very good.
Thank you.
Yeah. I wanted, on the NPLs, your forecasts are expecting the NPLs and I think and the cost-to-income ratios to come down in the next 5 years. Why have you made that expectation?
Fine, let me just continue. So as stated previously, we say that the economy is going to improve because as you look at the graph, there was a spike in 2020. The NPL was at 17%. But when you look at the trend before the pandemic, the NPL was ranging between 9, 10%. So we expect it to go back to those values, and it's because of the recovery of the economy. And I want Obe to explain more on the economic recovery that we had discussed.
Yeah, just on the NPL, as I mentioned earlier, there was a restructuring of loans that amounted to 49 billion, and this shows a high value for the NPL, but once the years go by, the value is actually, we expect it to go down. Yeah, so the high value was actually because of the restructuring to ease the financial burden that was caused on the customers due to the global pandemic.
Well, Richard is preparing some questions from Kevin. Number one, why did you not think OPEX was a KPI, given your conclusion that the banking sector is competitive? And then question two, if you grow deposits faster than borrowings, you significantly impact your liquidity over time. Will this result in more profitability or lower profitability?
To reiterate the first question on OPEX, kindly.
Sorry? Why did you not think OPEX was a KPI, given your conclusion that the banking sector is competitive?
OPEX is in one of our assumptions, I think. It's the second assumption, actually. We stated that OPEX increased in 2020 because of the pandemic. There was additional expenditure. However, we expect it to decline in the future because the bank is going to the digital side. So this actually minimizes the cost. And even when you look at the cost to income ratio, you see that it is actually, because when you look at some of the banks in the market, like Equity Bank, it has a cost to equity ratio of 64%, if I'm not wrong, which is very high. And you look here at Cooperative Bank, its current cost to equity ratio is around 54-55%, which is low compared to the banks that it's competing with.
If you grow deposits faster than borrowings, you significantly impact your liquidity over time. Will this result in increased profitability or reduced profitability?
Okay, so the deposit to loans. Sorry, I hope you can hear me clearly. Sorry for that. So the deposit, actually Cooperative Bank is different from what is there in the industry. Most banks have loans growing faster than the deposit. Yes, I do understand that to some investors it may look as a bad thing, but we also have, there's a point that was suggested by my colleague, that the private sector has gained more appetite for loans. And he will actually explain this. So the fact there's high demand for loans, and Cooperative Bank can actually give out more loans. Cooperative Bank is actually at a good position to take advantage of this. So it's actually a good thing. So I'll give my colleague to explain to you.
Just to add on to that, this is also in the private sector, the credit demand is going to increase, and this is because we attribute it to the fact that most private investors have high hopes for the economy to, most private investors have high hopes for a positive upturn of the economy. And the result for this is that it will increase the demand for credit. Yeah, just to add on to what Irene was saying.
Thanks. There is a slide, I think it was the one, you just go back from here. That slide, right? So under your investment summary and some of the merits that you mentioned, and I'll just touch on maybe two. There is the approval of CoopBank's risk pricing model. Unclear to me how that differentiates CoopBank from its competitors, given KCB is also having a model approved by Central Bank, right? So maybe a bit of exposition there. Then when you say, spiraling the revenue drive on soaring Eagle transformation agenda, okay, it's a nice statement, it shows growth, but, what are the specific, underlying drivers of this spiraling revenue growth that you mentioned? And likewise, even for the first statement, you say, Kingdom Bank shows signs of profitability in the future. Okay, it's a statement, but what exactly, are the signs specifically that underpin that particular assertion? Thanks.
Okay, to answer your question, I think I'll just start from the first point. So Kingdom Bank shows signs of profitability in the future. Historically, it is an acquisition of Jamii Bora Bank, and it was not performing so well. But Kingdom Bank has shown 100.5 improvement from the previous record demonstrated by, given by Jamii Bora Bank. So this just shows that the profitability for Kingdom Bank is really promising even into the future. Yeah, so it is a merit for our buy recommendation in that sense. The second point is spiraling the revenue drive through the Soaring Eagle transformation agenda. Some key pillars for this initiative include data analytics, digitization, which is I found to be a very influential one in this sense, because even once the operations are digitized, for a fact, the operational costs are going to decline, and the revenue will actually be accelerated in this sense. That's why we put it also under the merits. And then the approval of Cooperative Bank's risk pricing model. So we expect that the approval by CBK will happen, and the effect of this is that the ROE will increase gradually, and also the net interest margin will also increase for the next 5 years. That's why these points are under the merits.
To add on that, you were saying that the approval, there are other banks which are also applying for the approval also, but not all banks will be affected in the same way. We have to note that. So this is how this approval will affect cooperative banks specifically. And we identified that the effect will be positive. And it is worth noting that it is a merit to our recommendation.
Yeah, I have one more question on your valuation. What informed your weighting between the two valuation models? How did you decide on the 640?
So we settled on a 40% to 60% weighting based on the fact that our dividend discount model valuation is based on assumptions. And given that we are basing this valuation on specific assumptions, kindly go back to the previous slide. Given that we're basing this on various assumptions, we cannot come up with we cannot come up with assumptions that are certain up to 100% quality. Therefore, we chose to give dividend discount model valuation a lower weighting compared to the multiples method, because also the multiples method is based on a market approach. We're comparing cooperative to its peers. So with this, we gave it a higher weighting because we are seeing what is actually being experienced in the market. So this is what informed our weighting.
Just to add on to that, yeah, I'm just going to reiterate what she says. Yeah, the DM valuation is more scientific, and for the multiples, it's based on comparison. So it has a factor of new information and what is actually happening in the market. So that is also reflective of the model. So yeah, that's why we had the 60-40 ratio.
Great. Thank you so much, Team 7, for concluding round 1 for us. Let's give them a round of applause. We have officially concluded round 1. So round 1 will consist of your grade marks. Sorry. Your grading of your report and combination of the presentation. So we tally those reports within the next few minutes, and then we'll get the top 2 so that the top 2 can now compete for the final spot. All right? So bear with us for a couple of minutes. We do the tallying, and then we can proceed. Thank you.
So the results are in. There were 7 teams that participated. I will not give you any much anxieties. The grading was weighted, 50% based on the graders' marks, and 50% based on the judges' marks and allocation. So that is as per the rules. The plan was to have 2 teams go to the finals, but due to demand, there'll be 3 teams that will be going to the final, and then those teams will be given, immediately after this, will be each given 15 minutes to present, and then based on that, then we'll be selecting the final one, right, Joyce? Yes. So the teams, as per the numbers, are Team 2. Where are they? Team 2? Thank you. Team 6. And Team 7. So I guess they need to go out immediately, and then you're going to be called in to start presenting. This is the final round that will determine the ultimate winner. Thank you. It's just the teams that are there. The rest of the team, the other teams, please stay.
have 15 minutes. Great, your time starts now.
Good afternoon, ladies and gentlemen. My name is Olivia Kerry, and I'm here with my teammates, Team 2, to present our valuation on the Cooperative Bank of Kenya. And these are the following recommendations that we want to bring forward. Now, we issue a buy recommendation with a share price of 15 shillings and 27 cents and a potential upside of 18.37%. This is based on the share price as of yesterday, which was 12 shillings and 90 cents. Ladies and gentlemen, we base this on 3 key factors. 1, that there is economic recovery for higher potential of stock, higher pricing of stock. 2, that the Cooperative Bank of Kenya is uniquely positioned to leverage on technology for increased shareholders' return. And finally, that the Cooperative Bank of Kenya will capitalize on sustainability for higher pricing potential. Now, I'd like to give a brief description of the bank. Now, as we said earlier, the bank is present in 2 East African countries, Kenya and South Sudan. The bank is the third largest lender by assets in Kenya, and these assets are valued at 536.9 billion Kenya shillings. Therefore, the question becomes, what are the business segments? In what business segments does the bank engage in? 1, we have retail banking. These are services that are offered to individual investors. The second one is wholesale banking. These are services that are offered to your institutional investors, corporate investors, and governments. And finally, we have other group functions. Now, other group functions would include any services that are not offered by either the retail banking segment or the wholesale banking segment. And therefore, what we know of services such as this include stock brokerage, which COP does offer, as well as investment services. Based on this graph, we can see that the largest contributor is actually the retail banking, which contributes about 52% in terms of operating profit. Another thing we'd want to know is, how does COP generate its revenue? This is done in 2 predominant ways: non-interest income and interest income. I'd now like to invite Mugambi to come and take over from here. Mugambi.
Thank you very much, Olivia. I will look at the environmental, social, and governance. When we look at the environmental pillar, we see that COP had a 31% increase in green lending. And they've also been able to partner with IFC to secure IFC and other international corporations to secure lending to fund green ventures to the tune of USD 122 million. This is comparable to KCB and Equity, which have also been able to bolster their climate fund by securing funding with figures ranging from 150 million. So it is comparable to those companies. On the social pillar, we see that COP has spent 46 billion in development funding, and they've also been able to educate over 7,000 learners, second only to Equity's Wings to Fly program, but outpacing KCB's foundation, which has been able to educate 1,000 plus learners. We believe that where COP is lacking probably is the gender balance, where you have 46% versus 54% male. And this ratio becomes worse as you go to top management, where you have 19% in management and 15% female in the board of directors. Comparing this to Equity, this is weak. Equity has about 44.4% in the board of directors, female employees. So therefore, we believe that that's an area that COP can actually really work on. Looking at 4 factors, the board of directors and management being well experienced, looking at a favorable shareholding structure that reduces the chances of price attacks, and a remuneration that is actually pegged to performance, we give COP a score of 93 out of 100 on the corporate governance scorecard. I will now examine the 3 investment pillars, starting with 1, economic recovery for higher pricing potential. I would like 2 words to stick with you: contraction and recovery. We see that for Kenya and South Sudan, we have significant contraction in the gross domestic product, and then the recovery was projected at 5.60 and 5.3. We believe that this will bolster the loan book, which increases the interest income and reduces the cost-to-income ratio as individuals become more financially sound. Therefore, we believe that that will bolster the share price of COP. Moving to the second pillar, we believe that COP is uniquely positioned to leverage on technology for increased returns. I would like 3 numbers to stick with you. We have 49% transaction growth year on year, 30% commission from these online transactions. So looking at those two numbers first, that's an impressive growth for a year on transaction growth. So this will, and we have 30% commission from those transactions. So we believe that this will be an alternative non-interest income area for Cooperative Bank. And if we look at the yield on e-credit, e-credit has only been increasing for Cooperative Bank. Therefore, we have a healthy yield of 8%, and this represents a good interest income avenue for Cooperative Bank. Finally, last but not least, we have capitalization on sustainability for higher pricing potential. COP has a sound ESG structure. We have economic sustainability, social sustainability, and environmental stewardship. We believe that as investors begin to price ESG appropriately in the market, COP's share price will see an appreciation. This is not foreign to us, as we have seen that the NSE recently released an ESG reporting guideline. So we see that investors, fund managers alike are actually interested in the ESG standing of a company. I will now hand over to Firdosa to look at financial analysis.
Thank you so much, Mugambi. So for our financial analysis, we look at the net interest margin and also non-funded income. For the net interest margin, we have economic recovery, bolstering an increase in the net interest margin. This is through an increase in volume of the loans, increasing its revenues, and decreasing its costs. Also, due to COP moving towards online transactions, it has increased its efficiency, reducing its costs. For the non-funded income, we have the online transaction growth, which in 2020 was 164.7 million, and we project it to be at 300 million by 2025. Fiduciary duties and share registration services has also increased the non-interest income. Also to mention, we looked at asset quality, which has decreased significantly as we project it to be at 2025. The capital adequacy ratio will be increasing, enabling Cooperative Bank to be able to cater for its costs, especially during insolvency areas. For our valuation, we had the multiples and the DDM model with a target price of 15.27 with an upside potential of 18.37. For the multiples we used, KCB, Equity, ABSA, and Stanbic, because they had similar business models and revenue streams. What we did was, we had two models. We had the peers model and the industry median. We wanted to avoid the industry mean because of the skewness that it would bring in to the financial valuation. For our DDM model, we had key assumptions: beta, premium, cost of equity calculated from the CAPM model, the risk-free rate that we got from the loan, and the price to book value. I will now hand over to Tracy.
Thank you, Firdosa. Just before I go into investment risks, as earlier questioned on our industry analysis and competition, we carried out a quantitative Porter's 5 model, and under that, we saw the industry scoring of banking is significantly low, but with that, we still find reassurance for investors in the sense that Cooperative Bank, considering there's already a concentration risk of 42 commercial banks in Kenya, and Tier 1 banks only consist of 6 banks, shows that Cooperative Bank has been able to solidify its position in the industry. Also, looking at purchasing power, looking at the power of the buyers and suppliers also being low, it means with the high switching costs that it's not very easy for Cooperative Bank customers to be able to move from Cooperative Bank to other banks that are not as significantly large as Cooperative Bank as well. Moving on to the investment risks, we looked at key risks or risks that we saw that were high impact and also high probability of occurrence. Not to fail to mention that there are other risks too that the bank faces. The first was credit risk, and under credit risk we looked at the increase in non-performing loans. With non-performing loans, we took into consideration the fact that COVID-19 could have been a very big factor, and the restructuring of loan payments and mortgage payments too was a factor. Moving on to operational risk, we looked at digital system failures such as online customer feedback showed that slow transactions, the failure of transactions with debit and credit cards over some various transactions, and also some failed online transactions when moving money maybe across seas and also locally. This is an area that is very key for the bank, and investment in very good technology that can be able to assess, monitor, and rectify issues that can enhance user experience, customer experience, is very key. Also, under operational risk was data privacy. The enactment of the Data Privacy Act of 2019 is very key for banks. Considering non-compliance accrues a fine of up to 5 million or 1% of turnover of up to 5 million for banks is very key for them to ensure that there's a lot of compliance. Additionally, political risk. When we looked at political risk, considering that, cognizant of the fact that this is an electioneering year and general elections are coming up in August of this year, political electioneering periods are really mad with high political temperatures and intense campaigns, and this puts a lot of uncertainty on policies of that new incoming government will have on banking. Also, the fact that our NSE is heavily invested by foreign investors is very important for us to be able to reassure investors that Kenya is politically sound compared to most sub-Saharan African countries, and the track record we've had at least of the last 2 elections shows that there's been peace and prosperity throughout this, and we expect maybe the same to ensue this year. Additionally to this is compliance risk, as we saw that with the introduction or the change in IFRS 15, that on revenues from customer relations and needs, so that it changed how banking was able to report the timing and how profit recognition was done, and also how would they price their loyalty programs they have with banks. That's all we have for the presentation for now. Thank you, and we're open to questions.
Thank you. My comment, the company analysis was very good, but I keep missing the industry and competitor analysis.
So when we carried, the industry analysis was done through the quantitative Porter's 5 model, and this is clearly in our report, but we do understand that it's not present in our presentation, maybe because we structured the presentation also with time. But how we scored the quantitative on industry is with the Porter's 5 quantitative model, where we look at competitive rivalry, threats to entrants, purchasing power of buyers and power of suppliers. It was a score out of 1, and the diagram within our report shows that Cooperative Bank was able, considering the industry attractiveness was slightly lower, it was able to stand out, considering it's the 3rd largest bank in asset value, and considering also that with a low threat of entrance, it means more banks can't come into the space, considering there's already 42 banks existing in Kenya.
Thanks. So I think just as a point, even moving from report to presentation, it's important to have it because part of the review is the industry, the company, and the competitors. So if you do a deep on the company and miss out on the industry and the competitors, you can only be able to give it during Q&A, which disadvantages you. Yeah, thank you.
Thank you.
That answered the question, thanks.
A question, did you do any sensitivity analysis or scenario analysis?
I think honestly we didn't consider any sensitivity and scenario analysis at the time. I think the reason was generally just due to constraints that we had at the time. But we are cognizant of the fact that it should have been included. And hopefully, I think just generally we're aware that it's an important aspect in this yes.
I think for me, just a general observation, when you're, making allusions to certain points, so for example, under risks, the IFRS risk came in under compliance, it wasn't in your presentation. What you'll want to do going forward is whatever you're going to reference in your presentation or speak to needs to be there, right? You did a good job of outlining the companies that you considered given their relevance to Cooperative Bank. Those were mentioned verbally. It's always a good idea to have like a footnote stating those companies there, if nothing else, just for your remembrance. The whole idea being, you don't want to give the impression that you're making things up on the fly, right? Whatever you're speaking to is in your presentation. Yeah, thanks.
I have a question on your slide about leveraging technology. what impact do you expect it to have for non-funded income growth as well as improvement of cost-to-income ratios?
So the online transaction growth, I can answer the cost to income part first. It's significantly cheaper to lend and to process transactions using an online platform. So the cost to income ratio, maybe to issue loans through e-credit, is significantly cheaper as maybe hiring individuals to actually assess the creditworthiness of people. So it will decrease the cost to income ratio. Maybe you can remind me about the other question.
How does it drive your non-funded income?
So there has been 49% transaction growth year on year for the historical, which we project to only increase in future. There was a huge shift to online transactions due to the COVID-19 pandemic, and we believe that COP will only be able to, will only increase this as we move forward. So we believe that transaction growth, and when you have the transaction growth as the volume, and you're maintaining a good commission of about 30%, then the income figure actually goes up. The interest income figure, the non-funded income actually goes up. Yeah.
If all the banks are positioning themselves to leverage technology, how will corps differentiate themselves? I think all banks are alive to tech as an instrument to use.
I think I can hand over to Olivia.
All right, so we previously stated that there is the Soaring Eagle transformation. That's the famous agenda that COP Bank had put in place. Now, this system was put in place in 2014. When we compare this with the competitors that had probably just started, this agenda was put in 2014. Therefore, we believe that the bank had already put in systems in place since 8 years ago to ensure that this is something they can capitalize on. Now, when we see other banks, yes, they are using technology, but COP has done it over a longer period, has first mover advantage, and we believe that COP will obviously now have a better position in terms of this issue and technology.
Also, additionally, COP's model using cooperative societies, and now something new they added was called Circle-Link. So they partner up with circles to get their members registered through the online platforms, and also the cooperative societies, which they can leverage the cooperative societies, the Circle-Link, and now lastly, the agency model, which Equity brought in, but they're now capitalizing on.
Great. Thank you so much. A round of applause for Team 2. Team 7. Your time starts now.
Good afternoon once again, ladies and gentlemen. With me here is Team 7, with my team members Irene Zai and Mercy Wamboi. We initiate our coverage on the Cooperative Bank of Kenya based on a 12-month target price of 15.3 Kenyan shillings, which presents a 17.7 upside as compared to the last close, which was at 13.0 Kenyan shillings. Moving on, A brief overview on the business description shows that the main income drivers can be categorized as either interest income and non-interest income, with the following key income drivers for both categories. Moving on, a brief overview on the regional presence for the Cooperative Bank of Kenya shows that they have stable footing in South Sudan, with their subsidiary in South Sudan being the Cooperative Bank of South Sudan, and the subsidiary here in Kenya being the the Kingdom Bank, which is an acquisition of the formerly known Jamii Bora Bank. The bank has over 8.8 million customers with over 4,000 staff members. Moving on, we take a brief overview on the industry of the banking sector, just to get a view of it. So the banking industry in Kenya is quite competitive, and it has experienced a steep growth in profits for over the last 10 years. And the demand drivers and the supply drivers can be, as indicated in the screen, give us an overview of the banking industry in general. Moving forward, we take a look at the next slide. Sorry. The slide before that, Irene. Thank you. The competitive positioning of the bank. So the first factor that we singled out is the close relationship that the bank has with its consumers. An exemplification of this can be seen in the way the bank restructured its loan book for loans amounting to a total of 49 billion. And this shows that it has a view of close relationship with its consumers. The second factor is the growth sustained by its strong capital buffers. Now, Cooperative Bank has a resilient and agile capital buffers, which can be seen from the COVID-19's effect. The bank was actually commended, the CEO, Gideon Muriuki, was commended for leading the bank to be the only bank that issued a payout of dividends, and it also was the only bank that retained its employees through the effects of the global pandemic. Moving on, we'll take a look at the sustainable ESG factors, and I'll invite my fellow colleague Mercy to take us through it.
Thank you. Thank you. So, Cooperative Bank strives to promote eco-efficiency and sustainability through its operations. So, we'll look at the environmental, social, and governance drives steps that they've taken. So for the environmental bit, Cooperative Bank has taken up significant energy efficient investment, and it has also come up with an energy management policy statement which ensures that it manages its energy costs sustainably and efficiently. The bank also offers lending to individuals and institutions who are keen on promoting environmental conservation. So onto the social bit, Cooperative Bank, through its foundation, Coop Bank Foundation, provides education to needy and bright students within the community. We'll also look at the fact that Cooperative Bank also promotes gender and cultural diversity, and it has a 46% to 54% ratio of women to men among its staff. So we'll also look at the governance structure. So for this, we actually gave the Cooperative Bank corporate governance score of 96.3%. This was actually based on its good and sound corporate governance framework. So we'll invite Obed to carry out the investment summary.
Thank you very much, Mercy. Now for the investment summary, ladies and gentlemen, we reiterate our statement on the buy recommendation based on the following merits. Number one, Kingdom Bank shows signs of profitability in the future, and it has shown an improvement in its returns for over 100.5 from its previous record. The second point is the bank is spiraling its revenue drive based on the soaring ego transformation agenda. And this agenda was pitched and launched with an aim of stabilizing the competitive position that the bank has on the Kenyan banking industry. And true to this, it has had key achievements such as a 93% transaction shift from to alternative channels with a key focus on e-credit. Moving on to the next factor, it's the approval of Cooperative Bank's risk pricing model, and we anticipate for the Central Bank of Kenya to approve Cooperative Bank's risk pricing model, and the effect this will have is that it will cause a gradual increase in the ROE. It will also cause an increase in the net interest margin for the bank from 7.5% to 8% in the coming for 5 years. The last one is the investment in e-credit. So the bank has had a successful penetration of e-credit products into the market. For example, eFlex, which has had a significant impact on its consumers. We also have a demerit on our investment recommendation, which is the expansion to South Sudan, the South Sudan subsidiary. And the main concern is the fact that the economic climate in South Sudan is unstable due to hyperinflation in the country. However, it is key to notice that the post-pandemic returns were actually higher than the pre-pandemic returns. It is also worth to notice that we expect the economic stability in South Sudan to stabilize in the next years. Moving on, we'll take a look at the financial analysis, and I invite my colleague Irene to take us through it.
Thank you, Obed. So we are going to take you through the financial analysis. And our financial analysis was based on the following assumptions. The first assumption is on the ROE. So we expect the ROE to increase from 12.7% to 16.1% in the financial year 2025. And why are we saying it's going to increase? It's because, number one, the income growth is approximately 8.9%. And also, as suggested by my colleague, the Soaring Eagle transformation agenda is driving the company's value. Our second assumption is on the OPEX. So in 2020, the operating expenditure for the bank increased, as you can see on the graph. And this increase is mainly attributed to the fact that the bank had to spend more money so that it can meet the COVID-19 regulations. However, we expect it to decline in 2021 and increase at an average growth of 6.9% onwards. Our third assumption is on deposits and loans. So currently, as you can see, the deposits are growing at a rate of 7.4%, where the loans are growing at a rate of 6.6%. So we anticipate the trend to continue in the future, and it's also important to note that in the industry, this is not what is happening. Most banks are reporting a loan growth that is higher than the dividends. But this just shows that Cooperative Bank has the capability to lend more and meet the growing appetite for loans. So our fourth assumption is on the NPL, and we forecast that the NPL will follow a downward trajectory to 8% by the financial year 2025. And why are we saying this? It's because the economy is recovering, people are setting up new businesses, and therefore we expect that borrowers will be able to settle their liabilities. Our next assumption is on operational efficiency. And here we are going to be keen on the cost-to-income ratio. So as you can see, we expect the cost-to-income ratio to decline by the financial year 2025. And we expect it to decline to a ratio of 50%. And this expectation is hinged on the fact that the bank is shifting from operating with paperwork to digitalization. So this means the operating costs will decline. So this is just a summary of our financial analysis in ratios. And now I'm going to take you through the valuation. And here we had two types of valuation. We had the DDM and we had the relative valuation. So under the DDM, we made assumptions. So as you can see, we have a risk-free rate of 11%, and this risk-free rate is the 5-year bond yield in Kenya. The risk premium, beta, and the cost of equity were calculated using CAPM. The growth rates and the terminal ROE are from our financial analysis. So using all these values and putting them into the model, we had an intrinsic value of 15.5 Kenya shillings. Now to the multiples, we used 8 banks, all of them are Tier 1 banks, and they're all listed in the NSE. So we took the PE and the PBV ratio of each of these banks and used the median as our preferred way, and we got a value of 15.2 Kenya shillings as the intrinsic value. So now we have 2 valuations, we have 2 intrinsic values, and we applied a weighting of 40 to 60% so that we can come up with a share price of 15.3 shillings. So this, when compared to the 13.00 at close, we say that the company is undervalued. Therefore, this is a good opportunity for investors to buy low and sell high. So now I'm going to introduce Mercy to take you through the investment risk.
So we identify 4 key investment risks, among them valuation risk, market risk, political risk, and operating risk. So we'll begin with valuation risk. We conducted a Monte Carlo simulation using 10,000 scenarios, and in 83.1% of these times, we obtained a share price that was above 13.0, which is actually the current share price. So with this, we believe that we're able to obtain a share price which is higher than what the bank is currently trading at, therefore cementing our buy recommendation on cooperative shares. So we also conducted a sensitivity analysis using terminal ROE and growth rate of dividends, which are key metrics used in our dividend discount model. We can see that changes in terminal ROE result in a negative 15% and a positive 25% movement in the share price. And we can also see that changes in growth rate of dividends result in a negative 1.4% and a positive 1.4% movement in share price. So it's important to note that in many of these scenarios, we can see that the share price is actually higher than what the bank is currently trading at, therefore continuing to cement and continue to enhance our recommendation, which is that of buying the cooperative bank stocks. So we also want to highlight 2 key risks. So we'll go into the political risk. 2022 being an electioneering year, we expect political risk to heighten within the year. However, we note that cooperative bank has strong capital buffers, and the bank also maintains a neutral stance towards political matters. Therefore, we believe that the bank is able to shield itself from any macroeconomic shocks, if any. And we also highlight cyber risk to be a high risk that the bank is exposed to. So with movement of operations to the online systems, cyber risk or cyber attacks are a very high risk. However, with cooperative bank having efficient and strong systems, we believe that the bank is well equipped to actually mitigate these risks and to continue moving at a growing trajectory. So, ladies and gentlemen, with all these points that we have considered, we would therefore like to continue to enhance our buy recommendation on cooperative banks shares. And yeah, we'd like to enhance this decision, which is that of a buy recommendation. Thank you, and we'd also like to invite questions.
Thank you. Question for Obed. You had a slide on the merits of cooperative bank, and you cited the profitability of Kingdom being one that will really support them. I have a question about the opportunity that Kingdom would be able to capture for cooperative bank, which they could not do on their own without acquiring Kingdom. What advantages did Kingdom have that cooperative bank could not develop on its own?
Thank you for the question. Well, an acquisition is usually done, or this decision is usually made to expand to have a growth kind of system for any institution. And so the acquisition of Jamii Bora Bank, formerly known Jamii Bora Bank, now Kingdom Bank, is just but an added avenue through which cooperative bank will have extra revenue. And yeah, so previously it was performing dismally, but it has projected a 100.5 improvement from its last record, and this just shows that it's an added advantage. Yeah.
Just to add on that, so as stated by my colleague, this banking industry is very competitive. And for you to gain market share, you have to take drastic changes. for Cooperative Bank to acquire Jamii Bora Bank, it was basically also increasing its market share. Because now all the customers that were in Jamii Bora Bank become Cooperative Bank customers. Okay, thank you for your question. So for multiples, what you do first is that you take comparable companies that are close or have a very close business model to the company you want to evaluate. So now, we had first to consider the Tier 1 banks. And we couldn't go and take Tier 2 banks because they're not at the same level as Cooperative Bank. So we restricted ourselves to Tier 1 banks, first of all. And of course, we had to restrict ourselves to Kenya because Cooperative Bank is mainly operating in Kenya. So if you were to take other banks, because these other banks outside there, they have different macroeconomic issues that are facing them. So if we come and put them in evaluation with Cooperative Bank, then it will alter our finding. So that's why we had to stick to Kenya, because these banks were similar.
Just another question for you, Irene, on valuation. The growth rate is 8%. Our GDP is not expected to grow beyond 6%. Perhaps you can help us understand why you expect the long-term growth to be faster than our economic growth.
That's a nice question, thank you. First of all, we noticed that the Kenyan GDP is really going slow. Now, if we subject Cooperative Bank to that, will it be reasonable, really? That's what we asked ourselves first. Because Cooperative Bank has really been growing. From 2000 to now, the bank has really shown significant growth that was nowhere close to the GDP growth. Actually, it was way higher than GDP growth. So we decided we give it an 8% because this bank is moving faster than the economy. So that's why we came up with the growth of 8%. In the long term?
In that growth in the long term, then the bank, you're actually literally forecasting it will grow and become bigger than the economy.
I can see your concern, but then now, let's go back to our DDM valuation. We use the terminal ROE, because we know that you need to get a terminal value, and for the terminal value, you need a terminal growth rate. So instead of making an assumption on another terminal growth rate now for the long term, we use the terminal ROE that captures the value of the company's returns as of 2025. So this 8% is only applied from 2021 to 2025.
Yeah, fair.
Thank you.
Okay, I have maybe two questions and maybe observations. If we go to the slide for competitive positioning. Yeah, I sort of struggle to understand, you know, what these metrics show in terms of competitive positioning, because, you know, restructuring of loans, you've mentioned the 49B there, that's something every bank, not just in Kenya, but across the world did because of COVID. I think, you know, when you're thinking about this slide, you want to be a little bit more pointed in the competitive aspects you want to show. You mentioned also here that this bank paid a dividend during the COVID period. While that's a good thing, somebody could make a counter argument that paying a dividend at a time when business was generally slow means that you don't have the cash buffers you need to ride that period of poor business. So it could make you actually less competitive than banks who decided to withhold so that they have higher cash reserves. They're able to weather the storm before they resume. And again, Many banks, stopped paying dividends. Everybody sort of understood why that was the case. So you may want to just rethink the content on this slide. It doesn't quite speak to the title as it's presented there. Then finally, the slide for sensitivity analysis, if you just go towards it. Yeah, just a clarification from you guys in terms of how you have rated your cyber risk insofar as probability and impact. Is it a high impact, low probability?
Yes, we believe that cyber risks have a low probability of occurrence, but have a high impact. This is based on the fact that banks have set up really good systems to actually try and mitigate these risks. Therefore, even though it is a potential risk, we believe that the strong systems and the strong measures put in place and the regulations and everything that has been set up to ensure that this works will make sure that the probability of this risk is low, but then if in case it happens, the impact will be high.
Okay, I mean, your explanation tracks with what is there. I would also just offer a counter challenge to that in terms of being high impact and probably moderate to high capability now. Reasons being you had banks having to move from, in-person or person-to-person banking to more online or transactional. I know you mentioned that, they had an online transition period through their program going, but for the kind of banks which had to do it quickly, there was a huge element of trial and error. So, you have banks that could have been exposed there. It's just something worth rethinking, and possibly the same thing with the risk of natural disasters. You have it there on high probability. I would ask you which natural disaster we had in, the last 3 months. I can't remember one outside of the pandemic, which is affecting the globe anyway. So, you want to kind of make your sensitivity analysis as realistic as possible in terms of the risks that you're actually facing on the ground. Otherwise, the risk analysis then becomes less powerful in terms of your analysis. Yeah, but, good job, generally.
Thank you so much.
Great. Thank you so much. Let's give them a round of applause. We shall now have the final team, Team 6. Team 6. Great. Team 6, your time starts now.
Welcome all. This is Team 6. My name is Sami, is Derek, is Mark, and is Damaris. We are going to present to you on the largest cooperative bank in Africa. Thank you. Welcome, Mark.
Thank you, Sami. So we recommend a buy with a target price of 15 Kenya shillings. This represents an upside of 15.38% from the closing price of 13 Kenya shillings as at 7th February 2022. Now, the bank has a market capitalization of 74.3553 billion and also a free float of 765.66 million shares. The bank has a growth potential. The growth potential of the bank is driven by the dominant provider of financial solutions to cooperative divisions, SACCOs, pursuing cost rationalization, digitization and innovation, revenue diversification, and the Project 3C, which is connect, collect, and cure, driven by the motive to decentralize the loan portfolio. This growth strategy is anchored on the diversified portfolio's focus. Cooperative has focused on mortgage, retail, hotel industries, and also SACCOs for diversity in their portfolio. Also, the strong governance structure led by 15 board members, very experienced and very effective, being led by the CEO, Dr. Gideon Murioki, who has been in the banking sector for 32 years and also been a CEO since 2001 to date. So we have confidence in cooperative because of the much experience of the CEO and the board of directors. Also, the strong capital structure and high liquidity ratio of cooperative bank, growing on return on equity and dividends. The business description, Cooperative Bank is the largest bank in Africa, hosting 15 million members. It's also a dominant bank in Kenya with a market capitalization, as I've already said earlier, 74.5 billion shillings. And then it offers integrated universal banking models, and also it's a growing, agile and resilient bank with high levels of operation efficiency. The banking model cooperative offers a wide variety to its customers, including retail and business banking, stock brokerage, insurance brokerage, leasing, Coop Bank, Fleet African, and also funds under management. Under competitive analysis, under competitive advantage of Cooperative Bank, we've analyzed Cooperative Bank is offering customer-centric solutions in the sense that it has moved its services to online digital platforms where its customers can easily acquire the services of the bank without even going to the bank at their own convenience. This is easing efficiency and also the effectiveness of the bank. The other one is the Cooperative Bank has thrived in the sense that to its peers, it has really dwelt into SACCOs, which is a good thing because Cooperative Bank houses over 3,800 societies in Kenya. Also, the bank, we also used Porter's 5 forces of competitive positioning analysis to understand the position of the bank in its competitive nature, where the competitive rivalry high because of the many competitors. The supplier power, it's low due to the large number of suppliers to choose from. The buyer power, low, high number of buyers, hence unlikely to influence their prices or dictate their prices. Threat of substitution, it's high. Many peers dealing in the same and differentiated products. Threat of new entry, it's high. It's low, sorry, because of the stringent guidelines that the CPK has placed in order. Those are the ways of you can bank your money under cooperative. And as you can see, Cooperative Bank is moving to the digital platform. We have mobile banking, internet banking, and the rest. So I'll welcome Derek to take you through the financial analysis.
Okay, thank you, Mark. Okay. Based on the valuation of, based on the projected results of the bank, we estimated we estimate a sale, a buy of a share price of Kenya shillings, 15 shillings, with an upside of 15.8%. The bank in the year 2021 registered an increase in profit after tax, with an 18% increase in profit after tax to Kenya shillings 11.6 billion in that quarter of 2021, from Kenyan shillings 9.9 billion in the third quarter of 2020. Total operating costs, income, rose by 19.2% to Kenya shillings 44.4 billion in the third quarter of 2021 from Kenya shillings 37.2 billion in the third quarter of 2020. This growth can be attributed to increase in the non-interest income, and also we see that the non-funded income increased by 15.6% from Kenya shillings 15.7 billion to Kenya shillings 13.6 billion in the third quarter of 2020. Yeah. In terms of the balance sheet, we saw that the balance sheet recorded an expansion in total assets from Kenya, and it grew by 16%. The balance sheet actually grew by 16% in the year 2021, that is in the third quarter of 2021. Yeah. Going forward, that we also see that the bank assets also grew from the year 2020 to 2021, recording an increase of 17.5% to Kenya to 536.9 billion assets. Other banking metrics, we see that other banking metrics, we compared about the total liabilities of the bank. They increased in the year 2020. Yeah, we can see that the total, take me to the other side. The total liabilities, they decreased. The operating income, the borrowed funds, they increased in the year 2020 from the year 2019. This can be attributed due to the COVID-19 situation of the company, of the country, which led the banks to increase which led to high level of borrowings in terms of people borrowing from the banks. Non-performing loans also increased. Non-performing loans also increased. In the year 2020, non-performing loans were high, and it was attributed to to high loan defaults, in terms of high loan defaults, and also we can attribute the level of non-performing loans due to the economic situation in the country. The non-performing, the loans weren't so much performing, and many businesses made losses, so they never had the opportunity to, never get the opportunity to repay the loans on time. So the loans were recorded as non-performing loans. So we have the liquidity ratio of the company. The cooperative bank has maintained liquidity ratios of above 13% from 2013, and we see they keep rising year on year. The cost to income ratio also rose compared to the bank, and when you compare the bank and the industry group, it is so an increase in the cost to income ratio of 63% from 45% in 2020. The non-funded income also increased, which led to high profitability of the bank from 36.0% to 33.4%. We use the Cummins rating to rate the bank's performance in terms of capital adequacy, in terms of asset quality, in terms of management, in terms of earnings, and in terms of the liquidity ratio. In terms of capital adequacy, the capital adequacy ratios, we see that the capital adequacy ratios were high. We ranked Cooperative Bank as the tier 1 bank. So the capital adequacy ratios, we see that they are rising year on year. In terms of the asset quality, we compare the asset quality. In terms of the total assets, we saw the increase in rise of total assets, and also the return on average assets also rose from 2019 to 2020, recording an increase. Return on equity, or return on assets also they decreased from 2019 to 2020. Sorry. Earnings quality they also reduced in the year 2020 from the year 2019. The bank has maintained high liquidity ratios, as we have seen in the previous years. On to the valuation of the company. Cooperative Bank, we used 3 valuation models to value our company. We used the relative valuation model. We also used the price to book value model, and we also employed the price earnings model. We used under the relative valuation model, we compared the bank in terms of enterprise value and in terms of the earnings before interest, taxes, depreciation, and amortization. where we have the operation ratio of the EV to EBITDA as 4.95% of the cooperative bank, and in terms of enterprise value to sales, it recorded a ratio of 1.32. In terms of the price to book value ratio, use the price to book value ratio because it shows the prices and the capital adequacy of the bank, which are mainly core aspect of the balance sheet of the company. The investors can rely on these, the profits and the capital adequacy of the bank to value our company. And we came up with a price to book ratio of 0.8 multiple, which represented our target, our fair value of 15 shillings in the 1 year, with the 1 year target of 15 shillings. The price earning ratio, we used the fair value. We came up with a fair value of 16.79, which represented an upside of 30.7%. Okay, that was all under the valuation. Welcome my friend Sam to carry on the next part.
So, on the investment risks, just as other companies have just as other banks have the investment risk, Cooperative Bank is exposed to such risk, and basing on the likelihood of the occurrence of the risk and the impact that the risk can cause, the following are the risks. There is the credit risk, the market risk, the operational risk, there is the compliance risk, there is the systematic risk, and the strategic risk. In a way to minimize this risk, the Cooperative Bank of Kenya came up with a management process which involved four practices or processes. One was the risk profiling, two was the risk identification, three was the risk assessment, all the risk measurement, and the last one was the risk monitoring and mitigation. Other ways that Cooperative Bank has used are, one, there is the end-to-end assessment of the management practices that are kept in place so that they can manage the risk. Two, there is the strengthening the portfolio management and the frameworks that are kept in place. And the last one, there is the enhancing and accepting the corrections from the regulations that are sent to them. So I now welcome Damaris to take us on next part.
Our last part is the ESG. ESG consists of environmental, social, and corporate governance. Under environmental, Cooperative Bank of Kenya has acted as a steward of nature. Through this, they have adopted the paperless and also the end-to-end opening of accounts online. With that, it emerged as the best bank of Kenya 2020 as per the Financial Times in London. Also, the next part we have the social. Under social, Cooperative Bank of Kenya has ensured it is inclusive of the people with disabilities who have 0.4% and has 46% of women and 54% of men. For corporate governance, it has 15 board members, of which 14 are non-executive, and one of them is executive, who is the CEO, Dr. Gideon Murioki, who has 2% of shares, while the chair, Dr. John, has 0.02%, while the vice chair, MacLeod Malonza, has 0.09%. That's our presentation.
Thank you for that presentation. I was curious to know whether you had any forecast figures as you were doing your research, because all the numbers you have shared are backward looking. You've showed us the financials from 2015 to 2020, but I've not seen any forecasts in the, usually when you recommend a buy in an equity market, people are buying into the future of the company. And I've seen a lot of what the bank has been through in the last 5 years, but I've not seen any forecasts, what it will look like in the next 5 years maybe. Did you do anything like that?
Maybe to just give a hint on that, due to the financial uncertainties of the country, maybe due to the oncoming electioneering period, it was difficult to come up with to come up with prices, future prices, but we expect our Cooperative Bank of Kenya to grow with a on a 5-year target, or on a 5-year basis with a CAG of 3.1%. So it was it became difficult for us to vary because of due to change in the management of the due to the coming electioneering period, also based on the changes in the government of Kenya. So it was quite hard for to estimate on the future prices of the bank. Thank you.
Your valuation method, you use the relative valuation method. Did you consider using any other method? And why did you choose, zero down to that one?
Maybe to add on that, thank you for the question. Our major valuation model, which helped us to come with a target price of Kenya shillings 15, was the price to book value model. And we use this model because, as I've stated before, it gives us the correct value in terms of the prices and in terms of the capital ratios of the bank when it comes to the balance sheet. So the balance sheet in terms of the cash flows can be able to come up with the prices and the capital ratios of the bank in terms of how the bank is using the various capital structures to fund its investments. So our price to book value stood out with a price of Kenya shillings 15.
Thank you. You said that Cooperative Bank has a universal banking model. Are they trying to be too many things to too many people, or is this a strategic way to grow? With Cooperative Bank, they offer several services. What you framed as a universal banking model. They have deposits, I think maybe you can go to that slide, to amongst the initial ones. Yes, there. So they're offering all this in their banking model. There are other banks which are not offering all this and are achieving a higher return on their equity. So is Cooperative Bank just being very busy doing all this, or does this actually add value?
Okay, on this banking model, we are seeing that Cooperative Bank is offering a wide variety of services to its customers, and they are not doing it because they want to be busy. There are returns on these things, and you see, Cooperative Bank has a diversified portfolio compared to its peers, some of the peers. It's offering a wide variety of services to increase also the customer satisfaction level so that they can be housed in one bank instead of having maybe a certain account in this bank and maybe another service at another place. So they want to cater for every need for every customer, yeah, under one roof. Yes.
Some general points of observation for your food for thought. There's a slide. Just start from the beginning. I'll tell you when to stop. Okay, just go forward. There, the previous slide. Yeah, I mean, so when you're doing a valuation analysis like this one, you need to kind of, focus on the key points at hand, right? You're getting a valuation, so every other slide you have should speak to or, help explain your thinking around how you're getting to the structure, and your final valuation and your recommendation. This slide is basically not relevant to the topic, right? Nobody will need to know how to bank your money. Take it for granted that the people you'll be presenting to are probably aware of the various methodologies, right? So stay on topic. You know, if this slide was something else in terms of enhancing maybe your views on the valuation, you add more value to it, right? The other thing I would encourage you, and maybe it's just me, but as you can see, I have 4 eyes. The presentation at the front is really small, so it's difficult to make it out. What happens in a case like that is, you know, if the people who are judging you are even older than I am, and hence even more visually challenged, they will just immediately, you know, your mind just tells you, I'm not struggling for this. So you may want to consider enlarging your fonts. The other good thing about making your fonts more visible is it forces you to cut down on your narrative. When you have a font this small, you can put down so much information, right? There's a slide there that, you know, because you're also moving in a hurry because of time, I was trying to get through it in terms of reading, and before I knew it, you had moved to the next slide, right? Which is even, you know, further dissuading for me to put effort in going forward. So be keen on the sizing of your fonts so that they are visible, right? Think or be sympathetic to the person who doesn't have 20/20 vision like yourself, right? And then finally, in terms of your slides with charts, make sure you attribute the source of your information. A couple of charts there where there is no attribution. So if somebody wanted to try and confirm the info, just put something down there, a reference. It's just good practice in general in any presentation you're doing when you're looking at a company. But otherwise, you know, good job. Thanks.
Great, thank you. Round of applause for team 6. So we'll do the quick tally of the 3 teams and announce the overall winner within the next 5 minutes. Thank you.
we've overshot the time. I apologize for that. But I think we'll just get straight to the winners. First of all, thank you so much for the participation, for all the participants, both in the first round and the second round. We understand the effort that has been put in. I hope there have been good lessons. I hope you'll utilize the networking sessions effectively. From where I see it, and unfortunately we don't have time for the judges to tell us what they saw, but from where I see it, I saw very good presentations. And in some cases, I also saw where there was a whole lot of input that should have been done, to be fair. So I believe for the winner, you hold a significant, can I say, responsibility in ensuring that you carry the other teams that you've achieved over as you go to the next stage. And with that, I just wish to go straight to announcing the teams. So the finals, we had 3 teams that participated. That was Team 6, Team 7, Team 2. And according to the ranking from the 6 judges that were here, the team that came third was Team 6 of Kabarak B. Where are you? Team 6? Yes, maybe you can just stand so that I can clap for you. Thank you so much, and very good effort. The next team, the second team that came second pretty much, was Team 2, Strathmore A. Where are they? You don't want to stand, but we can clap for you. Yeah. Thank you so much. And of course, that means that the winning team is Team 7, Strathmore C. Big clap for them. We have some gifts here to be awarded. I'll allow Joyce to manage that.
So we will, as you are aware, the winning team will be awarded $500. Every participant here will go away with a certificate, so you'll not go empty-handed. And then we'll award trophies for the winning university, winning industry mentor, winning faculty advisor, and every team member of the winning team. Great, so we can proceed to that. Thank you. So I'd like a couple of judges to perhaps stand at the podium so that we can proceed with the gift giving, prize giving, rather. Francis, I need you to sign.
Sorry? I need you to sign these checks over there. They signed with my real signature. Yeah. Are you taking a photo of me signing?
So the winning team, please proceed to the podium. Do you have your industry mentor with you? Elias, Gillian. Your hosts, please let's have Elias and Gillian join them.
So that's for each team member. I think should. That's all I mean. Okay. Thank you. Maybe some of the judges can join for the photo.
Let's have one with the winning check. Your hard-earned money. Congratulations, Strathmore University Team C. Let's give them a round of applause. Job well done. Thank you so much. Thank you to our judges. Thank you for your patience. We may proceed to lunch now at second floor. Please proceed once you're done. But we can collect our certificates after lunch. Thank you. Congrats.
Thanks. I was not expecting that.
I know. But to see, you know the first round report.
Tell the winning team to remain on stage.
Okay, the winning team, please remain on stage.
Congratulations, Matthew.
Congratulations, Obed. Mild. Okay.
There are 4 questions. You can choose. So actually, it's going to be easy if you just see. How was the experience? What is the most important thing you've learned? What would you advise those who are thinking of participating in the research challenge?
Okay. Hi, my name is Obed.
Hi, I'm Masi Maina from Strathmore University.
Hi, I'm Irene Zai from Strathmore University.
I'm also from Strathmore University. Okay, sorry.
So how was the experience today?
The experience today has been really nerve-jarring because it was the presentations round and we had to have our points by the tips of our hands. But all in all, it has been really amazing. And this win really affirms that the work we put into our analysis and evaluation truly paid off. And we are so happy.
What is the most important thing you've learned today?
The most important thing that I think that I've learned throughout the whole experience is just to keep learning, keep learning and have fun while at it. Like, it's never that serious. And also keep working with the people that you're with, encourage them. It's fun when you're doing something with people, and it's been an amazing experience just working with my teammates. So yeah, keep learning and have fun.
What would you advise those who are thinking of participating in the research?
So the first thing I would say is make use of your industry mentor. Our industry mentor was just perfect. He was so nice to us. Shout out to Joe. We thank him a lot. We also would advise them to make use of the past presentations and the past reports done, especially at international levels, so that they can get a feel of how the financial analysis should actually be handled.
How I think we would have prepared better. Even moving on to the next round, probably the lesson we pick from this is that we really need to have the content at the tips of our fingertips, even as we move through to the next round. And also another important factor that I think we should have prepared more is on how we handle the questions. We should also, I think we will try to have a more critical approach while tackling the questions in the next round.
Has this experience made you want to join the investment industry?
Yes, it has, certainly. Because, before this, I thought I knew. But then coming into this challenge, learning what people actually do in the industry, it's all quite interesting. And I want to delve into that and to be an expert, just as all these people are. So, yeah, definitely going into that direction.
bado sijaenda.